Ladies and gentlemen, dear participants, welcome to our today's webinar on factoring for the AADFI and commercial banks and financial institutions. We wish to welcome you in this fruitful session co-hosted by Making Finance Work for Africa, Afreximbank and FCI. Before we start with our official program, I would like to provide you with a couple of logistic clarifications for the better communication and interaction with all of you. First of all, during the session, we will have the opportunity to take questions and answer them. You can post the questions on the Q&A part of our webinar. You can find the button at the bottom of your screen. Please use this function only to post questions. Of course, at any time, you may also use the chat function in order to raise any issue, but not for questions. Any technical issue that we will be able to support you or any other comment you wish to make. Finally, I would like to inform you that this webinar is being also hosted in French. So by choosing the button of the globe, which is again at the bottom of your screen, you're able to select the language that you wish to listen the participants, the speakers. So nothing more to say from me. Again, a warm welcome to all of you and to start with our official program. Thank you.
Thank you, Spiros. My name is Afek. I'm a financial sector advisor within the Secretariat of Making Finance Work for Africa. And today I will officiate as the master of ceremony for this program. I joins my word to yours to welcome the participant to this event and the co-organizer of this event. The logos of this organization are displayed on the screen. Just to give additional context to this event, I would like to quote a sentence of the president of Afreximbank, Professor Benedict Obama, by which he tried to emphasize the importance of factoring. He said, the immense contribution that factoring can make to small and medium-sized enterprise is the primary reason that has made these financial tools one of the most attractive to business across the world. I think this sentence really set the context. The purpose of this webinar is actually to educate African participants on this, on factoring and the benefit of introducing this instrument. The participant will have the possibility to engage with Afreximbank that is leading this the Africa chapter of FCI on the continent, and also have the opportunity to interact with Afreximbank and FCI on how they can introduce and grow factoring as a business line. On that, I will now invite the first presentations, which actually will be the beginning of introductory remarks. We will start with Mr. Peter Mulroyd, who is the Secretary General of FCI, a renowned figure in the industry, and he will intervene from very far. He has sent his video. I will now invite our colleague in the back office to display his video. Thank you.
Mr. Cyril Okoye, Secretary General, AADFI, Mrs. Marina Finken, Coordinator, Making Finance Work for Africa, and Mrs. Kanayo Wani, Executive Vice President, Inter-African Trade for the African Export-Import Bank. Distinguished guests, ladies and gentlemen, it is a pleasure to welcome you all to this factoring training seminar. FCI is delighted to be partnering with the Association of African Development Finance Institutions, the AADFI, the Afreximbank, and Making Finance Work for Africa to make this event a reality. This effort is all part of the initiative Making Finance Work for Africa, an initiative of the African Development Bank, a pan-African strategy to help develop traditional financing and factoring work in the continent. The initiative is a reflection of the level of interest in this exciting and relatively new asset class, receivables, and it could not be possible without the support and leadership of these great organizations. So on behalf of FCI, we thank you. Factoring is one of the most important financial services that can assist small to medium-sized enterprises in an economy to grow. It provides the necessary liquidity to SMEs by liquidating their receivables on the seller's balance sheet, which today globally averages about 40% of the total assets on the balance sheet of every seller around the world. Banks, governments, and regulators want to ensure the health of the financial sector, hence their reliance on financing typically hard assets, assets that you can touch and feel. Most emerging economies have a tendency to have an over-reliance on such hard assets, which makes it very challenging for SMEs to obtain the necessary financing for their survival. But receivables, which typically lie dormant on these companies' balance sheets, is also a very strong and reliable asset that is self-liquidating, can be controlled, and through factoring is a means by which SMEs can generate the necessary working capital to allow them to grow and prosper. FCI travels around the world to spread the seeds of factoring and influence governments and central banks in order to promote the concept of financing against these rather intangible assets, something new in most emerging economies we visit. We train new students, we provide consultancy services, we mentor, we gain new members within the network and provide support to our members to develop factoring from an operational, risk, legal, compliance, and promotional perspective. In fact, of the more than 150 members that have joined FCI in the past 5 years, nearly 70% are coming from the emerging economies. We know when factoring is conducted based on FCI's best practices as taught by the FCI Academy, members typically do not suffer when practiced the right way. This is why we are here today, to promote insight into how to deploy factoring in your markets in a safe and secure manner. The factoring industry's secure nature and the controls that it affords make this particular asset class much more attractive to investors globally. And we see this no different here in Africa. We're here to provide you with all the fundamental understanding and knowledge as to what factoring is and how it can benefit you in the future. Now, the factoring industry is doing extremely well. Global volume increased by 13.5% in 2021. Now, the 2022 official statistics are not yet available. However, thanks to some preliminary indicators, the same positive trend is estimated. We have received reports from our members in Europe and the US, for example, that expected growth will be better in 2022. In fact, the average growth rate amongst these members that have reported to FCI is around 18% on average in 2022 so far. We also can say that international factoring grew significantly last year. FCI's own system called AADFI factoring, normally a good barometer for the overall trends of global international factoring, generated turnover of over 27% last year. So I am confident that 2022 will be an even better year than in 2021. Increase in turnover is partly the consequence of inflation, of course, and the rise in prices, but a significant share can be contributed to the growing demand of liquidity after government supports have been lifted and the strong pressure on working capital. Regardless of the contingent situation, it must also be considered that the share of merchandise trade regulated based on open account terms is by far the largest one. And this is a clear indicator of the potential for the factoring industry in the future. Now, I have to say, we see headwinds in 2023. The year has not started off well, with news that the US is slowing. And although the pandemic seems to be under control around the world, including in China, risk is on the rise. I can tell you December itself was a very challenging month in North America due to the over inventory situation with retailers and distributors there. This stems from supply chain issues, the reason why companies wanted to buy products due to the increasing inflation and the increase in consumer demand after 2 years of this really challenging pandemic. And in Europe, the Eurostat reported a decline of 6% in retail sales in December. We see the collapse in the United States of Silicon Valley Bank as an example of the challenges there in the banking sector. And now we're getting reports of challenges even at Credit Suisse. Today, we face multiple interconnected challenges from economic uncertainty due to geopolitical fragmentation, stemming in part from the war in Ukraine. The threat of recession, the cost of living crisis, rising interest rates, the inflation higher than in several decades, in addition to mounting debt distress, will dominate the global economy in the coming year. Over the last years, we've had to face a never-ending cascade of calamity. Because of this environment, the global growth for 2023 is projected to fall below 3%. However, my friends, factoring always does extremely well during times of uncertainty. The growth rates after the past 3 major crises have all been in the double digits, just like the pandemic. After the crisis, due to the strength of our service, our role as a financial institutions is to continue to support the real economy, especially during these negative cycles. It is in times of crisis that our support becomes vital for SMEs in particular. When companies are trying to survive in this climate, it is greatly beneficial to get quick and adequate financial support. At the same time, we have to take care of some urgent priorities that will be the driving force for the coming months, such as cost savings, operational efficiency, and risk mitigation. So obviously 2023 is going to be a year unlike the last 2 years. It will be more challenging, but we are expecting also continued strength in terms of the demand for factoring whenever we see a decline in the risk environment globally. Ladies and gentlemen, we want to thank you for joining us for this virtual event. And of course, thanks again to the AADFI, Making Factoring Finance and Work for Africa, and the Afreximbank. And I want to say a special thanks to the African Development Bank, who, as many of you know, provided support to the industry through a generous grant it made to the Afreximbank and FCI to support the growth of factoring in Africa. I want to now give the floor to the next opening speaker. Thank you very much.
Thank you. Thank you very much, Mr. Mulroy, for this introductory remark. We continue with our round of opening statement. I will now invite Mrs. Kanayo Awani, who is the Executive Vice President of the Intra-African Trade Bank at Afreximbank. She is also the chairperson of FCI Africa chapter. Is the leading face behind the movement and the dynamic that we are observing on the continent with the development of factoring. She is very passionate when she always talks about factoring, and I'm sure that you will really appreciate her statement. You have the floor, Madam Awani.
Thank you, Hugh Kamawe, and thank you for your very kind and generous words. Hopefully I won't disappoint. Let me use the opportunity to acknowledge Mr. Peter Mulroy, Secretary General of FCI, Mr. Cyril Okoye, Secretary General of AADFI, representatives of development finance institutions and the other financial institutions represented here, dear friends and partners from FCI, Making Finance Work for Africa, and their colleagues, colleagues at Afreximbank, corporate leaders, bankers, factors, distinguished guests, ladies and gentlemen. It is with great pleasure that I welcome you all to our webinar on factoring for the Association of African Development Finance Institutions, AADFI, commercial banks, and financial institutions. At the outset, let me take this opportunity to express on behalf of the President of the African Export-Import Bank, Professor Benedict Orama, our most profound gratitude for honoring our invitation to participate in this event, which is organized in collaboration with FCI, Making Finance Work for Africa, and the Association of African Development Finance Institutions. The objective of today's webinar is to develop the knowledge, is a continued effort to develop knowledge, skills, and capacity on factoring, while also creating the awareness for the potential benefits of factoring as a financing solution to support the development of businesses, particularly small and medium enterprises across the continent of Africa. taking into account the contribution of the informal sector. SMEs account for about 75% of total employment in manufacturing. Africa's private sector is dominated by SMEs, and therefore any efforts to ensure industry development and export diversification needs to focus on and address the constraints faced by SMEs. Key among these constraints is access to finance, access to appropriate and affordable, and I dare say efficient financing is cited as a major obstacle for SMEs, which may reflect a number of different underlying causes, including lack of firm skills in preparing bankable proposals, lack of SME finance skills in banks, risk-averse financial institutions with excessive collateral requirements, lack of specialized financial institutions as well, shallow capital markets, or even a weak financial sector in general. Ladies and gentlemen, ensuring the availability of adequate and appropriate financing to SMEs is essential to help them grow and develop to their full potential. It's only through making such financing available to SMEs that they will be able to grow and mature and ensure that the opportunities provided for under the African Continental Free Trade Area are exploited. And we, as a region, can then achieve the ambitions of Agenda 2063, the Africa we want. We at Afreximbank wholeheartedly believe that factoring provides a viable and sustainable solution to address the SME financing gap and will help innovate SMEs grow and in turn support Africa's structural transformation and trade development. Factoring provides an important alternative to other external financing sources available for such SMEs, such as bank loans, leasing, venture capital. Accordingly, over the past decade, Afreximbank has worked with its partners to promote and expand factoring business in the continent, with a view of moving it from the fringes, from the periphery to the center. We are happy to share successes in this endeavor, including the provision of factoring of financing to support emerging and established factors, carrying out education, information and awareness campaigns, as well as having developed a model law in 2016 to create an enabling environment for factoring to thrive such that state parties can then domesticate it and into their own laws. Only this morning, I just witnessed a signing ceremony at the bank of a facility, a factoring line of credit to Bank Postal in the Congo. Also in Congo, what we begin to see from the adoption of the model law or a factoring law in Congo is the emergence and increased volume of factoring activities. In fact, statistics on factoring show strong growth and improvements across several verticals, including growth in volumes. The number of companies and the legal regulatory environment is also improving. For example, in 2021, factoring volumes in Africa increased to over 32 billion, up from 25 billion in 2020. FCI projects this volume is even expected to grow further in 2022 as we await those numbers. The number of factoring companies in Africa tripled from 30 to 93 between 2017 and 2021. The growth in factoring companies will also help drive greater volumes in the coming years. In 2022, 3 countries, Burkina Faso, Niger, and Togo, promulgated and adopted new laws on factoring. A clear, stable legal and a regulatory framework is the bedrock for anything sustainable. Hence, a good sign that Africa is embracing the calls that Afreximbank, FCI, and many other partners have been championing for several years. Distinguished ladies and gentlemen, while these successes should be celebrated, we are acutely mindful that there is a lot more to be done. Globally, Africa's share of factoring volumes remain very low, at around 1%. to increase our global market share and achieve factoring volumes of 50 million euros by 2025, as projected by FCI, it will require concerted and coordinated efforts by the factoring community, in fact, in Africa, but in particular, the financial institutions, DFIs, commercial banks, and factoring businesses. We, Africa's financial institutions, are arguably the most critical success factor and the key differentiators if we are to achieve the projected targets and even exceed the current 1% global market share. It is towards achieving these objectives that we organize today's webinar. It is imperative that the development finance institutions and financial institutions in general and the community of financial institutions are well trained, informed, and aligned on the best practices, standards, and operations for factoring. An alignment on the methodologies, products, and service offerings and practice of factoring is key for the standardization of the product as a viable and accessible alternative financing solution for SMEs. The session today will focus on the mechanics of factoring as a financial solution for SMEs. We'll also discuss the techniques in structuring factoring and receivable finance transactions and the management of compliance, operational and credit risks in factoring, and the key success elements for setting up factoring activities. The story of Afreximbank's interventions in factoring will be shared to highlight the opportunities, demonstrate the benefits, and motivate other DFIs to partner with Afreximbank to support the growth of factoring across the continent. Distinguished ladies and gentlemen, as I conclude, I see opportunities for collaboration between and amongst us financial institutions. This includes pooled funding, both direct and contingent, for factors in Africa, cheaper competitive financing through blended or blending concessional, and other forms of funding with commercial finance. This is a key value proposition and one that SMEs desperately need to become competitive and integrate into the supply chains, into their various value and supply chains. Another opportunity for a collaboration is to join forces in advocacy for the creation of the much needed legal and regulatory environment for factoring. There are also opportunities for collaboration in convening awareness creation and capacity building workshops across the continents like this one. Other DFIs and banks can support this initiative through the distribution and dissemination of the model law on factoring to state parties and stakeholders for consideration, and also advocating and supporting countries to adopt the model law on factoring. Afreximbank and FCI, working with various partners and stakeholders, hold at least 3 factoring and capacity training workshops every year. You're all invited to join this strategic partnership and imprint your institution's contribution on the history and the development of factoring on the continent. Ladies and gentlemen, before I conclude, please allow me to take this opportunity to invite members of AADFI and financial institutions present to join us as celebrating the 30th anniversary of Afreximbank this year. As part of what promises to be a momentous year, we'll host our annual general meetings from 18th to 20th of June, 2023 in Accra. I'd like to say that as the year progresses, we'll also having your database and contacts. We'll also invite you to other events that we're holding, such as a structured trade finance seminar, which we'll hold later in the year. We'll give you more information on that. That structured trade finance seminar also holds a workshop on factoring. We'll also have later in this year, Intra-African Trade Fair, dubbed IATF 2023 in November. We will send messages to you all, and I invite you all to participate. In conclusion, I'd like to once again thank Making Finance Work for Africa, AADFI, Association of African DFIs in full, and FCI for partnering with Afreximbank to jointly organize this event. I want to particularly appreciate Mr. Mulroy, the FCI Secretary General, for his untiring efforts in championing factoring on the continent. I trust that you all find this webinar a rewarding learning experience and encourage all of you to engage actively and exploit this opportunity. I thank you all for your kind attention.
Thank you very much, Madam
And Mr.
Kanayo.
Kamau, I think some people probably didn't hear me. I can also make the statements available after the seminar, after this webinar.
Thank you, Madam Kanayo. This is well noted, and I can assure you that you are remarkably exceeded our expectations, the insight that you share. We are very grateful to you making time to join us on this program. We'll continue with our round of opening remark. And now I will invite Mr. Cyril Okoye, who is the Secretary General of AADFI, and also acknowledge all his support. This webinar is actually the outcome of ideas or many ideas that we have been nurturing for a while in terms of collaboration between AADFI and Making Finance Work for Africa, and it has always been on our side. And we think that this partnership will grow as in the weeks and months ahead. Mr. Okoye, you have the floor. Thank you very much.
Okay, thank you very much, Mr. Hugh. Let me also recognize Mr. Peter Mulroy, Secretary General of FCI, Mrs. Kanaya Wani of Afreximbank, and Marian of Making Finance Work for Africa. So good morning, ladies and gentlemen. I welcome you to this factoring workshop on behalf of the Association of African Development Finance Institutions. The AADFI is delighted to be part of this program because of the values it portends for our members. So we thank our partners, the Making Finance Work for Africa, the Afreximbank, the FCI, for this collaboration. As you may be aware, the Association of African Development Finance Institutions is the umbrella body for DFIs in Africa. And most of our over 80 member institutions are DFIs that operate at the national level. These institutions are primarily established to promote and finance development agenda in their jurisdiction. They are responsible for mobilizing and channeling resources to achieve their development mandate. However, one of the challenges often confronting most of these institutions is their inability to access sufficient and sustainable funds to realize their mandate. So resource mobilization and mobilizing innovative resources are critical to African DFIs, particularly the national DFIs, in order to enable them to operate optimally. So this is why the association values factoring as another innovative financing tool for financing SME. Thus, we are happy to join hands in creating awareness on factoring through this timely workshop. We look forward to a very informative workshop and an outcome that will guide the AADFI in promoting the mainstreaming of factoring in the financing portfolio of mostly the national DFI. So I wish us a very fruitful session, and thank you.
Thank you, Mr. Okoye, for your introductory remark. Again, we appreciate these collaborations. I will now invite Mrs. Marina Finken, who is the Partnership Coordinator for Making Finance Work for Africa. She also have a brief remark. I think we'll listen to her in the course of the program, where she will also present the activity of Making Finance Work for Africa. Marina, you have the floor.
Thank you very much. Merci beaucoup, Hugues. Donc, je vais parler en français. Donc, comme nous avons effectivement des participants un peu venus d'Afrique, donc j'imagine qu'il y a des francophones parmi nous. Donc, bonjour ou bonsoir à tous selon l'endroit où vous êtes en ce moment. Au nom du secrétariat de Making Finance Work for Africa, je me joins à M. Mulroy, à Mme Kanoye et à M. Okoye pour vous souhaiter un chaleureux bienvenue à cet atelier qui porte donc sur la facturage. Comme l'a dit M. Okoye et Hugues plus tôt, donc ça fait un certain moment que le secrétariat de Making Finance Work for Africa et l'ADFI travaillent sur l'organisation de cet atelier. Et vous voir aussi nombreux aujourd'hui est vraiment très gratifiant. Nous vous remercions vraiment pour votre présence. J'aurai l'occasion de vous parler un peu plus en détail de Making Finance Work for Africa à la fin de l'atelier. Mais une chose que je peux vous dire, c'est que le développement des services financiers abordables, responsables, qui répondent à la fois aux besoins de nos PME et qui favorisent l'expansion du commerce est une de nos priorités. Madame Kanoye a bien rappelé l'importance de soutenir les PME africaines qui sont vraiment le poumon de nos économies. Et comme nous le savons tous, ces PME souffrent d'un important déficit de financement et on observe aussi un important déficit de financement du commerce. Ce sont des déficits qui se chiffrent à des centaines de milliards de dollars. Et on voit aussi que beaucoup de nos PME, même lorsqu'elles arrivent à dégager des chiffres d'affaires satisfaisants, stagnent ou encore, pire, vont faire faillite. Juste pour des problèmes de trésorerie ou des retards de paiement. Et donc, la facturage, nous sommes vraiment persuadés que c'est un outil de financement alternatif qui permettrait de répondre à ces différents besoins, à ces différents challenges. Et par nous, j'entends aussi bien Making Finance Work for Africa que nos différents partenaires qui sont réunis donc aujourd'hui, Afreximbank, AADFI et bien sûr FCI. Et en plus, la facturage représente de très belles opportunités de croissance et d'activité pour les établissements financiers. Donc, au tout début de cet atelier, M. Peter Mulroy a bien rappelé que c'est une industrie qui se porte à merveille, et ce, malgré les challenges macroéconomiques que nous traversons actuellement. On observe des taux de croissance à double chiffre et les perspectives restent très, très positives. Donc, c'est un outil qui a fait ses preuves à travers le monde, comme l'a rappelé le professeur Orama et Hugues nous l'a rappelé aussi également au tout début d'atelier. Juste à titre d'exemple, en Europe, 80% du financement du commerce passe par la facturage et seulement 1% en Afrique. Donc, c'est pour vous dire que le potentiel en Afrique, il est tout simplement énorme. Il y a des signes encourageants. Madame Kanoye nous a bien présenté les taux de croissance qu'on observe actuellement sur le continent africain. Et pour moi, votre présence aujourd'hui, le nombre assez élevé de participants est un signe tout aussi encourageant. Parce que là, en fait, on voit qu'il y a une certaine curiosité, un intérêt certain pour les métiers de la facturage. Donc, j'espère vraiment qu'à l'issue de cet atelier, vous partagerez la même conviction que nous sur la nécessité de développer les activités d'affacturage en Afrique et sur les opportunités que ces activités représentent, aussi bien pour nos PME que pour les établissements financiers. Et surtout, je suis convaincue qu'avec la participation, la contribution précieuse d'Afrexim et de FCI et l'expertise qu'ils vont nous apporter aujourd'hui, cet atelier va vous fournir des outils et des pistes nécessaires si vous souhaitez développer ces activités d'affacturage au sein de votre organisation. Donc, merci beaucoup pour votre attention, pour votre présence aujourd'hui. Sans plus attendre, je vais repasser donc la parole à Hugues pour entrer dans le vif du sujet. Je vous souhaite un excellent atelier et j'ai le plaisir de vous retrouver à la fin pour une présentation plus détaillée de Making Finance Work for Africa. Merci encore. Hugues, the floor is yours.
Merci beaucoup. Je vais parler aussi en français à ta suite. Marina, merci beaucoup pour ces mots d'introduction qui vont conclure effectivement la phase des remarques introductives. Tu es revenu de manière beaucoup plus détaillée sur l'importance de la facturage. Peut-être juste pour renforcer ce que tu viens de dire, Marina, le gap de financement des PME en Afrique dépasse 400 milliards de dollars. Donc, la facturage est donc en soi un instrument qui permet de répondre à cette problématique. Et je crois qu'on n'a plus besoin d'insister pour convaincre les partenaires qu'il y a lieu de s'engager dans ce business qui est lucratif. Je pense que pour avoir beaucoup plus d'éléments sur le sujet et renforcer le contexte, nous allons donc inviter Monsieur Nassourou Aminou, qui est le Regional Manager africain au niveau de FCI, voilà, et qui pilote tous les programmes donc qui permettent de développer la facturage sur le continent. À toute fin utile, je voudrais dire que la Banque africaine de développement, elle aussi, est très investie sur cette problématique. Elle a d'ailleurs, comme on l'a dit au tout début, apporté un concours en termes de dons à Afreximbank et FCI pour développer un certain programme qui vise à l'éducation et le renforcement des capacités en matière d'affacturage sur le continent. Donc, il y a lieu quand même de le reconnaître ici. Merci, Nassir. Tu as la parole.
Merci Hugues, merci pour cette introduction. Mesdames et messieurs, bonjour. Je vais parler en anglais, vous pouvez aussi poser vos questions en français. Donc, welcome to the webinar on factoring for AADFI and the commercial banks and financial institutions. I hope my screen is displaying. So, okay. So I'm going to present actually FCI, the evolution of factoring and receivable finance, the opportunity we see in Africa and also the challenge we are facing. So my name is Nassourou Aminou. I'm a regional manager of FCI in Africa. So about FCI, FCI is a division of FCIs to be a global association for open account, receivable finance industry. Our mission, receivable is our core of focus to the association is focused on factoring, invoice discounting, and supply chain finance. So we are the global voice for open account receivable finance. We facilitate, we promote international factoring through our platform, AD Factoring. FCI is really actively support the growth of the industry around the world, and we work jointly with policymakers and stakeholders. We promote also the best industry practice through education. We have FCI education. We will talk more about it later. FCI publish every year information and statistics about industry. We endorse also financial stability, prevention of financial crime, and respect of regulatory compliance and conduct. So we are FCI. We are we have 6 regions around the world. We have America, we have Western Europe, we have Africa. I am sitting in actually in the head office of Afreximbank. We have a giant initiative for Africa chapter led by Madame Kanayo, the executive vice president of Afreximbank. We have a region of Southeast Asia, Northeast Asia, and Europe and Middle East. So we have around the world around 400 members. In Africa, we have around 40 members, 10% of the number of members around the world. So we have a global and regional presence. We have a partnership with Afreximbank. We develop a relationship to building a network to support the initiative to develop factoring. We understand that to resolve the gap of financing of SMEs, factoring is a tool to resolve that issue. Is also a tool for the intra-African trade transactions. So we work also with ICC and World Bank, many other organizations. So give me a second. We will share a video about the story about FCI. I will leave my colleague to share the video. Gwendolyn, you have a floor. Gwendolyn, do you want to share the screen?
The first foundation stones towards the creation of modern-day factoring were laid in ancient Mesopotamia around 5,000 years ago. Not long after that, in ancient Egypt and Greece, debts were acknowledged in writing and recorded on papyrus. But it wasn't until the Roman era when the first debt collection specialists appeared. They received a commission of up to 1% of the money collected from the debtor. The Romans spread that concept throughout Europe as their empire grew. The term factoring actually comes from the Latin word facere. Nearly 1,000 years after the fall of the Roman Empire, this early concept of factoring kept developing, and the first factoring communities appeared in England and France, starting in the 13th and 14th centuries, respectively. The factors of Blackwell Hall in the City of London operated as agents for the woolen trade, and in France, Jacques Coeur, King Charles VII's finance minister, led his 300 facteurs to far-off lands to trade. The concept of factoring arrived together with the Pilgrims from the Mayflower's voyage in the 17th century, when the era of common law factoring began in America. This practice was later elevated when del credere factoring was introduced in the early 19th century, commencing the era of modern factoring and creating independent factoring companies untethered to any single industrial. Factoring returned to Europe after World War II. In the early 1960s, first harbingers of FCI appeared as a group of banks and independent factors from Sweden, Denmark, Finland, Norway, the United Kingdom, and the United States created a loose federation, initially called Factors Chain. 4 years later, in 1968, it was transformed into Factors Chain International, known today as FCI, when this initial group of 6 factors met first in Germany and later in Sweden, where the very first and official annual meeting of FCI was held, founded by 15 companies from 12 different countries. Today, FCI is a global association representing nearly 400 members in 90 countries. The members contribute nearly 90% of all global cross-border factoring activity. FCI has a strong and vast volunteer army ready to support the industry, including the members of the technical and executive committees and our global ambassadors who participate in the development and implementation of strategies and execute for the betterment of the industry. 50 years after its original appearance on the market, FCI is witnessing the dawn of a golden era for the receivables finance industry. Governments, central banks and regulators from around the world view factoring as a safe and secure method of financing trade and an instrumental tool to support the growth of SMEs. Whether it is the trading network, education, promotion, advocacy, legal and arbitration services, or just helping to spread the seeds of factoring to the far corners of the world, FCI is there, working for you.
Merci. Merci, Hugues. Okay, we're going to continue with the presentation about the market. So Madam Canayo already said that about the market. After the world transaction of factoring around the world, the global volume captured by FCI is around 2,000 billion 93 euro. So this is an increase against last year of 13.5%. So the major country around the world is mostly Europe, who represent 69%, followed by the Asia Pacific with 24%. Then we have North America 3% and South America 3%. So be curious to say why there is no factoring in US. So we'll talk about this later. Africa represents 1% and Middle East 1%. So for Africa, is the 1%, like there's an increase volume of 28%. The total market with 32 billion euro. So we see some growth despite the last year COVID. So we see some growth in the market. So most of the transaction is led by South Africa, then Morocco, then Tunisia, Egypt. So we see also the increase since the adoption of the factoring law in Egypt in 2019. The number of the factoring increased from 5 to 30. So we have also Mauritius. We see some activity around Africa, but we didn't consolidate to be sincere. We didn't consolidate those data because they are not member of FCI. But we see some growth in some country. I will come back on this point later. So in the market structure in 2000, we see in each country we see about 5 biggest factoring companies for each country, with who represent 83% of the market. So this is dominated by bank, 46% bank division, to 27% of bank subsidiary, and 10% of the non-financial institution. So in some of the market, most of the products is in the major market is represented by no-recourse factoring with credit, no-recourse factoring with without credit assurance at to 35%. Though we have recourse factoring with credit assurance with 17%. Then we have invoice discounting and who represent 18%, and then reverse factoring and supply chain factoring. So globally, the factoring is dominated by domestic factoring around 81%, and then international factoring around 90%. So we see on the different market with our experience. So most of the country they start with no-recourse factoring and domestic factoring. They move to invoice discounting, and then later with international factoring. And then most in the mature market, we have reverse factoring and supply chain finance. So for US, we mostly see asset-based lending in the mature market. For example, in the US, it's really popular, the asset-based lending. So we have here the comparison between the different products similar to factoring, because what we see in the next 5 years, 10 years, or 20 years, letter of credit, factoring will replace letter of credit. So we see here in 10 years of evolution, factoring with against letter of credit, credit assurance, we see some increase of factoring since 2012 until now. And then also, I want before to talk about the market, we need to have to do a definition of what is really factoring. So we include in factoring and receivable finance everything what we call in recourse factoring, no recourse factoring, maturity factoring, import factoring, reverse factoring. So some of country in Africa, what we see, there's a confusion between bill discounting, invoice discounting, invoice finance, invoice level finance, purchase order finance. Some of countries, they are mostly focused on invoice purchase order finance. Sometimes people say, okay, overdraft is also for factoring or advance loan. Maybe there's sometimes also confusion between receivable finance and debt financing. Some people call supply chain finance as confirming or payable finance. So for the export factoring and import factoring, mostly people think also ask what's the difference between import-export factoring with letter of credit. So that is very important to have this difference to see what's going on the market. So just here, just I give as an example, we have a panorama of a bank in Africa. We have the top 25 regional bank ranked in Africa. So most of them are in South Africa, the mature market for factoring. Egypt, we have is a mature market. Morocco, we have more than 5 factoring company. Nigeria, we have huge bank in Nigeria, but we didn't see a lot of development in factoring. Mauritius, then we have Kenya, we have Togo, we have Algeria, Ethiopia, and Angola. That is the top 10 of banks in Africa, of countries where we have a major banks in Africa. So most of the time we see around 25 in 25 countries we see activity of factoring. So Africa have more than 22 countries, 52 countries, 54 countries. So with the economic zone, West Africa, Central Africa, East Africa, North Africa, and Southern Africa. So in this market, mostly is dominated by at least international bank or Pan-African banks, who they are present in sometimes 7 countries to 30 countries, like ABSA, like EcoBank, like Stanbic, like UBA, GT Bank, Atijari, and SocGen, Bank of Africa, Atlantic Bank. And then also we have some small, largest and dynamic local banking for each country. So what we see here, there's a lack of knowledge and experience. So banks are not too, factories are not too developed. It's taking time to banks to prioritize or to learn more about from competitor to understand the factoring before to engage. So there's also a gap about the SMEs need, about $136 billion. So SMEs represent 90% of businesses in Africa. So what we see also, there's an interest of development of factoring in Africa the last 5-10 years. Mostly like there's adoption of the law lead by Afreximbank. For example, Cameroon adopted the law in 2014, Benin in 2017, but we didn't see any activity, for example, in Benin. Egypt in 2019, as I said before, the number of factoring companies increased from 5 to 30. So Central Bank of West Africa, BCA, will adopt the factory law in 8 countries. Like Madam Kanayo said before, there's some country adopt already this law, domesticate this law, like Togo, Niger, Burkina Faso, Mali. So we will see later for shortly, more probably Cote d'Ivoire, Guinea-Bissau, and Senegal maybe adopt this law. Madagascar changed the banking law to introduce factoring. Congo adopted the factoring law in 2022. DRC changed the banking law to adopt also factoring. So the market start to move following. This is also the result of the conferences of promotion lead of event we have for awareness, for interest on factoring as an instrument for the economic development of countries. This is undertaken by Afreximbank and also FCI. So, and in the last, as I said before, in the last 10 years, so we see in those countries, 2 factoring companies, 2 banks who do factoring, for example, in Cameroon. Now we see in Senegal is moving around 4 banks. Cote d'Ivoire, there's a lot of interest shown by banks, around 5 banks doing factoring in Cote d'Ivoire. Ghana, we have Gabon also, Congo Republic with Banque Postale, Burkina Faso, Nigeria, we have one company, but we can find some banks, they didn't really say they are doing factoring. Maybe they just say, okay, we do another product. So most of those companies are not a member of FCI because we have in Africa around 40 members. So just to show there's the need, the development of factoring in the last few years. So I want to share with you also the study made by World Bank IFC for the market study in Cote d'Ivoire. The potentiality of factoring supply chain finance estimate is 3,800 billion CFA. So that means $6.5 billion. That is the potentiality opportunity of factoring and supply chain in Cote d'Ivoire. So actually, only bank use only if I make maximum around 100 billion CFA. So that means there's a gap of need of supply chain on factoring on this market. So another study made also in Kenya, but IFC in Kenya, around 28 billion of opportunity in Kenya. That's if you convert it in shilling, about 3,000 shilling of opportunity of factoring supply chain. The same study was made also in Nigeria about Nigeria. The potentiality is $27 billion of factoring. So we didn't see anyone who do factoring or supply chain in Nigeria. So we have around, if you convert in naira, it's 11 trillion naira of potentiality. So that's why for us it's very important to do those webinars to support banks, to support them to really come to the market to do supply chain. So what is the challenge? So what we realize in the market, the challenge bank facing is a lack of knowledge, education, skill, and experience. If there is no experience of factoring, they can engage. So also maybe it's costly, and the implementation process maybe it takes like 3 months, 6 months, or maybe a year. The legal environment and regulation was not clear. There's a lack of legal framework in different countries. So sometimes there's a capital requirement to be a factoring company in some country. So we have economical environment, access also to working capital, like inflation. If you go to some country, the inflation is higher. There's a high interest rate in some country, more than 20%, maybe, for example, 30%. The cost, so that's the impact of cost of lending, security. We have a delay of payment. So we see also the lack of credit assurance, credit information. So banks also need to know how to manage the factoring transaction, and also there's a career in terms of the barrier, in terms of international factoring, in terms of the language. So we have extensive advocacy with Afreximbank and in Nigeria, Kenya, Algeria, Cote d'Ivoire, DRC, with Pan-African Capital. There's a strategic partnership with Africa Development Bank, Afreximbank and FCI with the FAPA grant to support the capacity building for emerging factoring company. We already support around seven factoring company to launch factoring. We provide them e-learning, more than 200 free training on FCI e-learning. Africa Capacity Building Foundation raised a paper on challenge or opportunity, or if you want it, we will share it with you. So banks are mostly interested now on full factoring, no recourse factoring, reverse factoring, involvable finance, and also purchase order finance. So there's more involvement of bank. We have a new large player in the market. We need the top management to be involved on the, we have a project owner, sponsor. We need, bank need to have a dedicated project team, efficient involvement. They need also to have a flexible or modulable IT system to have more confidence, efficiency, and control factoring operation, because they can't do factoring with the core banking system. They need also to have a support in terms of the capacity building, consulting for the deployment of the activity or factoring business operation. So we are able to support them. We need also the implementation, training, deployment takes, as I said before, 4 months or 6 months, or maybe a year. So take advantage of FCI Academy, FCI Consultant. We have a coaching program, we have a mentoring, we share our best practice also. So just to say quickly, if you allow me, because we are running out of time. So we have 40 members in Africa, and the different countries I see here. So we have different type of members, full members, who is a company who really do import, export factor with more than 20 million euro. So we can use, bank can become associate member if they want to do international factoring. So maybe they will start with associate member. We have also a sponsor member. So just to give you the highlight of the evolution of our activity in Africa in terms of the education. So we have a lot of demand in terms of the foundation courses. We have a demand of the intermediate courses and so on. So for example, the last webinar we do with BCA, we have around 1,000 people attending. The second one around 250 in last year. So if you have, if you need more information, you can go on our website, our annual review. We have a newsletter every quarterly. You have in our website, we have around 1,000 documentation about factoring. We can take advantage of this. So we have a lot of activity last year in the Democratic of Congo, who changed the banking law. BCAO, Egypt, Congo, Nigeria were working, hopefully by this year or next year. So this is one of the events we attend in Nigeria in 2021. Then also during the Intra-African Trade Fair in South Africa last year with the participation of Nexim. This is in Congo. We have a joint conference with the Ministry of Government of Congo to do the regional conference in South Africa, Central Africa. Then in the sideline of Afreximbank Trade Finance Seminar, we have one day dedicated of factoring. We have one day also workshop with Egyptian Factoring Federation to talk about international factoring. So we have also a West Africa workshop to train around 7 banks to launch factoring last year in November in Dakar with cooperation with COFED, who is the training center of BCAO. This is our annual meeting last year in Washington, D.C. We're expecting to see you this year in September in Morocco for the second time in Africa. We will hold a FCI annual meeting. We'll expect around 400 people. So just also for your information, we have also in June our regional conference in Dakar. So you are invited. Maybe we will know more because it's very, very special. This one we have 3 days, 2 days for factoring and 1 day for credit assurance. So if you want more information, you can follow FCI on the LinkedIn, on Twitter, on Facebook. And thank you. So if you have any information, you need any question, please send it on the chat. So I hope I didn't take too much time on this presentation. Thank you again.
Thank you, Nasuru, for this very enlightening presentation. You have provide additional context to the topic. You share the global landscape of factoring. You share an overview of the market in Africa, and also you provided information on the recent the trends and the outlook for factoring in Africa. And it's also good this invitation to participants to join some of your event or some have access to some of your some information related to factoring post this event. I think the context is well stated. We now move to more the techniques and how you really develop factoring practically with a presentation from Mrs. Asian Sentitas, which she's the education director of FCI. For those who have attended past program on factoring, you have certainly seen her. Otherwise, first time, and probably you will continue to see her as you become maybe more involved in factoring. On that, I will invite Mrs. Asian to take the floor.
Thank you very much. I would like to continue with my presentation. I'm sharing my screen, so please wait a moment. Okay, hopefully everybody can see the screen clearly. I would like to give a 30-minute presentation now about what we mean by factoring when we talk about it, the definition, and the mechanics, how it works, who are the parties involved in this transaction, and the products. So what type of different products we do have in the factoring environment. But before I start, I would like to make an announcement. You may have some questions during the presentation. Please use the Q&A section in the Zoom that we can find out your questions clearly and easily. As well as during the presentation, my colleague, Deputy Education Director, Mr. Spiros Solis, can reply your question while I'm going to speak. I would like to start with the definition. We will talk a little bit about the technicalities now, the technical part and the fundamentals of factoring. I would like you, if you are not familiar with it, very closely, I would like you to have a very clear understanding what the product serves to all the parties. Factoring is not only one product. This is very important to mention. It is a package of different services. It is a combination of different services which a financial institution can offer to its clients. And another important feature is it is applicable only to open account trade receivables. When we say open account, we talk about such trade receivables which are on payment terms, for example, 60 days, 90 days, and there is definitely no underlying collateral security guarantees behind of the transaction. So open account means the seller is open to all risks. For example, the default of the buyer, unpayment of the buyer, so unpayment risk of the buyer, or if there is something goes wrong during the transportation, or if there is any reclamation dispute raised by the buyer. So all these risks are faced directly by the seller. So the seller is exposed to all of these risks. However, the most important risk is of course the credit risk of the buyer. Therefore, open account trade receivables are always very difficult for the sellers to accept, and also difficult for the financial institutions to finance. Factoring is such a tool. Indeed, it's a combination of different services, as I said, which is perfectly applicable for open account trade receivables. This tool or this service, this package can be offered by a subsidiary or division of a bank. So you can embed, if you are a financial institution, if you are a bank, you can embed the function in your organization, or you can create a separate division, or you can establish a separate sister company, a subsidiary of the bank, or maybe you are an independent provider or an independent investor, and you can develop your own factoring business. What are the services we are talking here? Yes, here there are. There are 4 different services under factoring. First one is the credit cover. This is the credit protection for the default, bankruptcy, and for the failure of the buyer for any reason and not pay the receivable on the due date. In other words, this can be considered as a trade credit insurance, but factoring and credit insurance is not the same one by one. Some conditions are different. In most of the cases, factoring has a more favorable and more advantageous classification or facility provides to the sellers. The second service under this umbrella, under factoring, is collection. The factor, indeed, I will now come to this next slide. I will explain how it works and you will understand it better. In terms of the collection, the seller is not responsible for the collection any longer. The collection service is transferred or taken over by the factoring company or factoring institution or the bank, whoever provides the factoring facility. And the factor directly interacts with the buyer and follow up with the collection for the collection with the buyer. The third service is financing. Maybe this is the most demanded service, or this is the most important service in emerging markets, in developing countries, and etc. This is very important because in that way, by the assignment or with the assignment of the receivables from the seller to the factor company becomes the owner, so the legitimate owner of the receivables, and against that, he can easily give advance financing or advance payment to the seller before the due date of the subject receivable. And the amount of this advance payment can go up to 80, sometimes 90%. This depends on the credit risk or the potential risk the financial institution sees in this subject business. And the final service is accounts receivable ledger administration. this is not a frequently used service or provided service by the factors in emerging and developing countries. This is a service which we commonly see mostly in developed countries, like in the West European countries or like in the Americas, like in Canada. This is literally a bookkeeping of the factor on behalf of the seller company. But today we will talk more about for the first or on the first three services. Let's repeat again: credit cover, collection, and financing. What is factoring legally meant, legally speaking? So there are three main parties. The first one is the seller, exporter, manufacturer. So these three are all the same. Second party is the buyer, and the third party is the factor. And the seller and the buyer has a contractual relationship between themselves, sales contract or the purchase contract. And from this sales contract, there is a kind of receivable being born after the shipment has been made. And the seller will or may assign this receivable. Receivable is a legal tool or a legal name, legal term. With the assignment of the receivable to the factor becomes the legal owner of the receivable, and after that moment, he is the only party who is able or responsible to contact the buyer for the collection, for the payment. He can make the advance payment back to the seller. If there is any dispute or reclamation raised by the buyer must notify the factor directly, and etc. And after this assignment of the receivable, the factor provides one of the following services in order this service comes to be, legally speaking, to be the factoring service. Receivables ledgering belongs to these services, collection of receivables, or credit cover service, which is, in other words, is protection against bad debts. We cannot talk about factoring if there is no receivable and if there is no assignment. So these two legal items or legal terms are inevitable tools for factoring. So receivables should be always with payment terms. At site, receivables are not subject to factoring transactions. There should be always a payment term. This could be between 30 days up to 180 days maximum. So we are not talking here long-term transactions. We are talking here short-term transactions when we talk about factoring. And what is assignment? Assignment is the transfer from one person to another person, either the total or a part of the assigner's contractual rights to payment, which is the receivable, from a third person by an agreement between the assigner and the assignee. Maybe the definition in one sentence is a bit complicated to understand, but if you will look at the graphic below, you will very clearly see the three parties in the transaction. This is a very simple transaction model. Usually in domestic market, you face such transaction models. There is a seller and buyer. Seller is the assigner because he is assigning the ownership and all rights belonging to the receivable to whom? To the factor. Factor is the assignee. Assigner and assignee are the legal terms, but usually in normal business, we use supplier, seller, or factor, or the financing institution. The third corner is the buyer, the debtor, or the customer, meaning the same, who is taking the receivable, I mean taking the shipment, and also obliged to pay the proceedings of the receivable to the factor company in line with the factoring contract. You see also the contractual flow and also the payment flow between the parties. So first of all, between the seller and customer, we assume there should be a sales contract, a purchase contract. If there is no contract, then it should be at least a purchase order. So a proof, a documentation which is proving that the customer is demanding some goods or some services from the supplier. This is number one. And the seller makes the delivery and sends the invoicing, which is the proof of the receivable. After that, we assume there should be an agreement between the factor and supplier documenting the assignment, which is the factoring agreement. And based on this factoring agreement, factor performs or executes the assignment of the receivable. The seller executes the assignment of the receivable to the factor, and the payment flow happens directly from the buyer to the factoring company. In this part, we will see very basic factoring products. So the fundamentals of factoring here we are talking about. The first product is domestic factoring and full service. Full service meaning that the factoring product includes credit protection, financing, and collection. So if a factoring product, the factoring package includes all three services, then we name that type of product full service non-recourse factoring product. Here we see three corners again, buyer, seller, and factor. And we assume these three parties are located in the same market, in the same country in Africa. And here we see the flows. The first one, buyer places an order, seller ship the goods, together with the notification of the assignment, sends the invoice to the buyer together with the goods. Based on the already signed factoring agreement, the seller makes the assignment of the subject receivable to the factor. The factor makes advance payment to the seller, and on the due date, the buyer pays to the factor on the maturity the full amount of the receivable. And after the factor received the payment from the buyer, whatever is remaining from the payment amount, the factor deducts the advance payment amount, or he deducts fees, any commissions, the interest amount, for example, and whatever is remaining, he pays as the remaining amount back to the seller. But if the buyer will be in a default, in insolvency, in bankruptcy, or he doesn't pay without raising any reclamation related to the goods or related to the relationship between him and the seller, then depending on the credit protection service, which is the non-recourse case, the factor makes payment under approval to the seller. This is the main difference of the non-recourse type of factoring, because the factor takes the credit risk of the buyer, and if the buyer fails to pay the receivable, then the factor pays the amount of the receivable to the seller. This is the main difference. What is the role of the factor here? Financing the seller, monitoring the seller-buyer relationship, performing the credit evaluation on both the seller and the buyer, following up the collection of the invoice from the buyer, and taking the buyer's credit risk in case of the buyer's default. The next example, again, a domestic factoring transaction, but in this case, it is a with recourse case, which means the factor doesn't provide credit protection for the buyer. The seller gets involved in factoring business together with factor, not for the credit protection service of the buyer, but only for having the collection service and also the financing service. Let's see the flow here again. Number one and number two phases are the same. Buyer places the order, seller ships the goods, notify the assignment, seller assigns the receivable to the factor, factor makes the advance payment to the seller. Up until here, everything is like exactly the same as in the previous example I have given to you. And on the fifth step, the buyer pays when the receivable is due. But just in case, if the buyer doesn't pay because he has no money to pay, because he has bankrupted, then the factor doesn't pay and under approval to the seller. So which means the factor should get the reimbursement, should recover his advance payment from the seller directly. And therefore, this type of product is named with recourse because factor has a right to have a recourse back to the seller. In the previous one, the factor doesn't have a right of recourse back to the seller. Therefore, it is called without recourse. What is the role of the factor in this case? Financing the seller, monitoring the seller-buyer relationship, performing again the credit evaluation. Although there is no credit protection on the buyer, in any case, there should be a credit evaluation on both sides and following up the collection of the invoice from the buyer. You see here, there is no taking over the credit and performance risk of the buyer directly by the factor in this type of product. The third example is now a kind of cross-border factoring transaction, which is also called international factoring transaction, but in a direct way. Here we see again three-corner model, seller, buyer, and factor. But the only difference here is the buyer is abroad. The buyer is located in another country, not in the local market, but in an international market. We assume here the seller and the factor are in the same country, but the buyer in a third country, which is our second country, which is Germany in our case. Let's see how it works. Buyer places an order again, seller ships the goods, notify the buyer with the assignment, assigns the receivable to the factor, and the factor makes the payment, advance payment to the seller. Buyer pays the factor on the due date, but if the buyer doesn't pay the factor on the due date, as the factor already takes the credit risk of the buyer before upfront, the factor should make payment under approval or payment under guarantee to the seller. You can ask me how the factor is able to guarantee a buyer which is abroad. There are several ways. Some factors are using credit insurance, trade credit insurance scheme to insure this risk, or they are using, for example, some Afreximbank credits insurance or ECA insurance, or two-factor system of FCI, but I will come to the two-factor system of FCI in the next slide. This system is more risky than the two-factor system, and also it is more risky than the domestic products because the buyer is in a third country and the factor should take the risk of a buyer which is located in the third country. Here is the financial risk, of course, here is the market risk, of course, here is the credit risk of the buyer, of course, and also the legal risk of a third country. The next product is the cross-border two-factor system of FCI. Different than the previous examples, here you see four corners or four parties: exporter, importer, but not one only factor, two factors, export factor and import factor. The reason here why we have two factors, these two factors are partnering with each other to give the factoring service to seller and the buyer in different countries. Export factor is located in the same country with the exporter, and import factor is usually based in the same country with the importer. Import factor represents the importer and the buyer, and export factor represents the seller. The role of the export factor is finding the seller, introducing the factoring product and respective services to the seller and exporter company. Also, another role of the export factor is giving the financing to the exporter. What are the obligations or the services roles of the import factor? Import factor takes over the collection of the receivable from the buyer in the same country, and also import factor grants the credit limit to the export factor on behalf of the buyer. So there is a split of the services between export factor and the import factor in the two-factor system. In other words, they are partnering and collaborating for providing the factoring service to buyer and the seller. How it works? We have, first of all, there should be an interfactor agreement signed between the export factor and import factor. And also, it's important to mention here that both export factor and import factor should be the members of the FCI association, because there are certain legal scheme binding these two parties while they will be working together, while they will be collaborating together. And one of the legal documentation which is binding the two parties is the interfactor agreement, which has to be signed between export and import factors before they enter into their very first factoring business. The second step, again, the same system. Seller receives the order from the buyer. There should be a factoring contract signed between the seller and the export factor. The seller should send the buyer limit application to the export factor. Buyer limit application is a form which is to be filled by the seller, which all the required information related and about the buyer company. The export factor receives this buyer limit application and he submits the same application to the import factor he selected to work with in the importer's country. The import factor makes the assessment of the buyer in-house, or he can approach a trade credit insurance for having a credit line for the buyer. Whatever he prefers, if he decides that the importer is worth to be granted a credit limit, which is required exactly the amount by the export factor, then he gives this notification, submits this notification of the credit cover on the buyer to the export factor. In the second step, export factor informs the credit limit to the exporter, and after that moment onwards, the export factor knows that when he makes a shipment to the importer, this shipment will be guaranteed by the export factor and subsequently by the import factor under the credit limit of factoring. Having known this, by knowing this, exporter sends the invoice together with the goods to the import factor, and at the same time he assigns the same invoice to the export factor. Export factor assigns the invoice to the import factor because the ultimate owner of this invoice, of this assignment, should be the import factor. Why? Because import factor is providing the credit guarantee. And if the importer goes bankrupt or by any reason he is unable to pay, the import factor is the party who take over the credit risk to make the payment under approval to the export factor and subsequently to the exporter. And in the worst case scenario, import factor is the party who will start the legal action in order to recover his money from the importer. Therefore, the assignment should be with the import factor. As against the assignment, the export factor makes the advance financing to the exporter. On the due date, the import factor makes the collection, so from the importer, payment of the invoice to the import factor. As soon as he receives this collection, he pays 100% of the collected amount to the export factor, which is, in other words, is called remittance of funds. And after the export factor received this total amount of the collection of the receivable, out of it, he deducts the advance financing, he deducts other fees, interest amount, and etc. And whatever is remaining has to be paid back to the seller. This is a simple flow of the two-factor transaction in cross-border factoring under FCI scheme. What happens if the buyer doesn't pay without raising any reason, without, if he files bankruptcy, unable to pay, insolvency or whatever, then in that case, the import factor must pay under approval within 90 days of the due date pertaining to the respective receivable. The two-factor system includes 4 different services again: financing, collection, credit risk protection, and accounts receivable administration. But as I said, there are 2 factors, and these 2 factors are sharing the services with each other. Financing and AR administration are on behalf of the export factor. Collection and credit risk protection are performed by the import factor. What are these services? So credit protection is the service in case of non-payment by the buyer because of financial difficulties or another reason other than dispute. Then the import factor pays under approval, or from time to time we call it payment under guarantee. Both are same, in full, in the total amount of the approved receivable at the 90th day after the due date of the invoice. So this is the rule for the payment under approval in case of the two-factor business. The second service is collection of invoices. Here we mean the import factor takes care of collection, so the seller or the export factor don't get involved in that process. Import factor does this collection process with reminders, written reminders, oral reminders, telephone calls, maybe invoice verifications. And the advantage of the import factor here, he is in the same country, he knows the attitude of the buyers, how to pay, and he speaks the same language of the buyer. So this brings a lot of comfort to the seller for the collection. The third service, which the seller cannot find anywhere else, is the dispute assistance. If there is a dispute raised, a commercial dispute, of course, I'm talking here, then the import factor and the export factor helping the seller and the buyer to settle the dispute as soon as possible, either in a friendly way or in a legal way, if this is requested by the exporter. In the third part of this presentation, I would like to talk a little bit about who are using factoring, for which type of companies it is useful or mostly applicable, and what are the benefits for all the parties. Why factoring is so important? We said, I'm sure that you will recall very well that we said that factoring is the best solution for financing for open account receivables. This is definitely true, but this is more true for more relevant than in the sophisticated countries, in countries where it is very difficult or less likely to have access to easy finance or to optimal finance for the SMEs or MSMEs, which are emerging markets and developing markets. So as we all see, there is so the markets are going to open account more and more. There is very strong competitive environment. Big buyers are very strong. They are dictating and imposing their terms on small and medium-sized enterprises. There is a global trading environment, and due to internet, very easy communication, people and companies are having very quick information and fast information about the trading terms from each other. Importers prefer to have the same terms as their local market. What do they have in the local market? LCs are no longer accepted by the majority of buyers. So if you summarize all of these changes, necessities, requirements in all markets by buyers and sellers, it it's inevitable. There is a very upgoing trend, increasing trend for the benefit and the advantage of open account trade and open account solution. And factoring is one of the best tools for the financial institutions if you want to penetrate with your financing, with your lending into open account trade in your markets. Who is using factoring? You see here a graphic comparison of clients by company size in terms of numbers, in terms of turnover, factoring turnover, and in terms of factoring advance payment. In terms of numbers, so small and medium enterprises are the leaders in this sector. So most of the users, most of the clients all over the world are smaller and medium enterprises, but this doesn't mean that large companies are not using factoring. It's on the contrary. If you check the turnover and advance payment, here you see that large companies are taking the most part in the total portfolio of turnover and advance payment. Why SMEs are important? SMEs are the backbone of the world economies. They are playing a major role in all economies, in emerging and developing markets. They represent about 90% of all businesses, more than 50% of employment, and contribute up to 40% of GDP in emerging economies. Having said that, while these SMEs are so important, unfortunately, they are facing a lot of problems, a lot of difficulties, because they have weaknesses such as lack of equity capital, they have limited resources for investment, shortage of skilled workers, they receive competition from larger companies, and unfortunately, they are in lack of negotiation power. So how can we help them? How we can assist them? Here you see a list of benefits to the sellers, and most of them are for SMEs. Why factoring so important and so advantageous in emerging markets for the SMEs at all? Because the receivables itself, the invoices itself, can be converted to cash at early stage of the existence. So let's assume SME is using factoring. He made the shipment, he produced the invoice. Invoice is the proof of the receivable. He assigned the receivable to the financing company, the bank, and he received, without waiting 90 days, for example, until the due date of the receivable, he received 80% of the subject receivable as advance payment. Please be assured, this is very important again, factoring payment is not loan, because there is an assignment, there is a true sale of the receivables to the financial institution. In case of a loan, maybe the exporter or the seller provides or gives a receivable to the bank, but as a security, as a collateral, as a pledge. So it is not directly a true sale. However, in case of a factoring, based on the jurisdiction of, of course, subject on the jurisdiction of your own environment, of your own country and market, the receivables can be assigned, can be sold, and based on this assignment, the advance payment will be considered or should be considered as if not a loan, but a payment against the receivables at an early date. Factoring can improve the cash flow, because as long as there is a receivable, the seller will receive the financing from the financing institution, which means an improved cash cycle for himself. Collection is done by the factor. This is a transfer of service from the seller from the factoring company. Factor, in case of a credit protection of the buyer, factor makes the assessment of the credit worthiness, and then the seller gets rid of this burden and can get payment under approval in case of a buyer's default. Factoring facility increases with the growth in revenue, with the growth in turnover. So as long as there is more invoices, more turnover, the factoring facility, the amount, the limit of the factoring facility will improve in the same way. Bad debt protection, which is non-recourse case, we talked about that. Potential to offer longer terms to the buyers. We said that buyers are more and more demanding longer terms. Of course, in case of factoring, this goes up to 180 days for special cases, but usually it's between 60 days and 120 days. And no additional collateral needed. So because the receivable itself is directly the collateral and security for the financial institution. What are the benefits for buyers? There is not only benefits for the sellers, there are benefits for buyers and financial institutions as well. So the buyer can make the purchase with deferred payment terms, and he can increase the purchase volume. It provides increased purchasing power to the buyer without using the bank lines, like in the LC or letter of guarantee. In case of a two-factor system, the buyer and importer can deal with a party which is in the same country and with the same language. Goods can be bought without any delays, without complication and cost of opening letter of credits for the importers in the import case. In some environments, this system, factoring assignment, can be used to improve the return on asset and equity ratio in the balance sheet, in the financials. What are the benefits to banks and factors? Again, as said, for the financial institution, the receivable should be deemed as collateral. And this is such a deal, you have a continuous monitoring over the lifetime or during the lifetime of each transaction, which provides a better collateral to the financial institution, better collateral value compared to short-term open account bank finance or straightforward bank loan. First of all, you are the owner of the receivable with all rights over the goods. Secondly, you have direct monitoring, a greater collateral control. Third, which provides to the financial institution better knowledge on markets and sectors. It is proven also the product is a low capital utilization and low loss given default ratio product. There are hundreds of selling opportunities and portfolio diversification for the bank. If you are providing non-recourse type of factoring, you have risk sharing opportunities with third parties. For example, you can share your the risk of the buyer with the insurance companies, or in case of a two-factor business, share it with the correspondent factor of FCI. And more, most important, it provides to the financial institution secure involvement or secure access to open account SME financing. To conclude, I would like to give a little bit information about reverse factoring as well. Reverse factoring is the other way around, or payables finance, the other way around of the receivables finance or normal factoring. The main difference is in the normal factoring, in the traditional factoring, the product or the transaction is initiated by the seller, by the exporter. However, in case of the reverse factoring, the transaction, the product is introduced or initiated by the buyer, which means it is a buyer-centric product. Also, like in the traditional factoring, reverse factoring falls under the receivables purchase category. Receivables are purchased on a basis of true sale, and the rights entitled to the receivables are transferred to the bank. What is the international practice? Program is originated through a large buyer. So first of all, one of the basic differences here, the buyer must be a very big buyer with multiple medium-sized or small-size suppliers. Based or leveraged on the credit worthiness of the buyer, the financial institution being in the middle of the buyer and the middle, so small suppliers, the financial institution is able to provide financing on basis of without recourse to these small entities. Bank assume the credit default risk of the large buyer, which means there is no recourse back to the small suppliers. Facilities are post-shipment. There is no pre-shipment facility and can be derecognized or can be off the balance sheet for the supplier because it is without recourse to the supplier. And the buyer continues to treat the obligation as a trade payable on its financial statements. So the buyer should keep the trade payables in his balance sheet until he pays the respective receivables to the financial institution. This is how it works. It shows the flow to you. Here there are three main parties, the supplier, the buyer, and the bank. In the middle, we see the buyer. The buyer sends the orders, the goods to the suppliers, and the supplier ships the goods to the buyer. By the way, the buyer has already signed a supply chain finance agreement or the reverse factoring agreement with the bank. Here, the requirement is, or here the rule is, the buyer will confirm to the bank that the shipment has been received and there is no dispute related to the respective receivable, and the buyer gives the commitment to the bank that he will make the payment on the due date. And this type of commitment, this type of confirmation is irrevocable confirmation from the buyer. Upon receipt of this commitment, the bank asks the supplier if he wants to be financed based on this commitment of the buyer. If the supplier wants to be financed, then the bank pays the full amount of the receivable to the supplier. So this is how it works. And on the fifth step, the buyer pays on the due date the purchase price to the bank at the agreed payment date. Again, the main difference or the main differences between traditional factoring and the reverse factoring are, first of all, the traditional factoring is started by the supplier, by the exporter, by the seller. And contrary, in case of a reverse factoring, the buyer is the party who is starting this product together with the bank. In case of the traditional factoring, there is a kind of split of obligations between seller and the buyer. However, in case of the reverse factoring, the buyer irrevocably commits the payment, which is not the case in case of the traditional factoring. And the supplier takes the financing only in case he needs the financing. There is no obligation for the supplier to take the financing from the bank for all receivables. Here you see some features for reverse factoring. Again, beneficiaries of the funding in factoring, in reverse factoring are the suppliers. The credit is risk allocated fully on the buyer. The supplier signs the receivables purchase agreement without recourse. So whatever I have explained already to you in the previous two slides, here we are collated again one by one as the features of the reverse factoring. What are the advantages? There are numerous advantages. First of all, for the suppliers, this is a very good tool because it's off balance sheet financing. The price is based on the buyer's credit rating, as the buyer is a very creditworthy and big one. So the seller, the small and medium-sized sellers, can use financing with the credit rating profile, with the credit rating of the buyer, which is a good benefit. There is no credit studies, credit assessment required for the buyer, for the sellers by the bank, but definitely there should be a KYC and AML process to be fulfilled before onboarding. The documentation short and simple for the seller side, and there is absolute flexibility to discount some, all, or none of the invoices. Benefits to buyer, it is a tool for working capital improvement and for improving purchase cost, improved supplier relationship because supplier is provided financing with the rating of the buyer, simplified payment process and reconciliation and less inquiry in case of any reclamation and etc. Because all type of reconciliation and less inquiry is performed between buyer and the bank. Benefits for the bank regarding client and transaction information. So there are cross-selling opportunities, again, improved understanding of purchasing and payment patterns, again, for the bank and financing needs. Regarding credit and counterparty risk, the bank is a very constant and close relationship with the buyer, and there is an early warning capacity in times of liquidity problems on the buyer. Revenue generation is another big advantage because of the buyers. The bank is being in close contact also with hundreds of small size or medium size enterprises, which provides to the bank a big opportunity for cross-selling of other products. I would like to thank you. So this was the most important, one of the most important presentations today in order to make you clearly understand how the products work and what do we mean by product and what are the advantages for all the parties. I would like to thank you for your attention. And I would like to give the work back to our moderator. Thank you.
Okay, yes, thank you very much, Eshen, for these very enlightening presentations on the concept and the techniques of factoring. I think now all the participants are more or less at the same page in terms of understanding of factoring practice. I think just to give them more information, we will take a few questions, try to answer them, before continuing with the session. I think this was the end of the first part, but probably we will just go straight into the second part of the program afterwards, not taking the break unless the moderator thinks otherwise, so that we can really kind of catch up on time. So just going back to the questions, you see there are a few questions in the chat box, but there are also a number in the how do you say? I mean, the question is the Q&A box and also in the chat. So we start with the question in the Q&A box and see if you can answer them. I don't know whether I can read, but I will start with the first one from Mr. Shaw, which is actually,
okay.
I can read it here. If you can see, then you can take it, or I read.
See. Yeah.
Okay.
Okay, I can
yes,
see. I can see.
Mm-hmm.
Okay, I'm reading. What type of training is available for the company to help them identify their participating from training? Okay, I think we are talking about in the question about the training, basically. Indeed, in the coming, one of the coming presentations, my colleague Spiros will give some information about our training system. As FCI, we have an FCI Academy, which has a comprehensive training program at different experience levels for companies dealing with factoring, or for financial institutions who would like to start with factoring. We are having some tools and trainings for individuals, maybe exporter companies, importer companies, for all type of stakeholders, so to say. Maybe after this webinar, we can send some information to all of you about what we can offer to you from the FCI Academy. We have online courses. Online courses are continuous e-learning courses. So there are some intervals. We are opening some of the courses, and some of the courses are ready to have, meaning that on demand, you can directly take the course and study at your pace. all these questions. So I see here maybe 10 questions in one question, and you may find the answers all of these questions in the study material. Maybe one of my colleagues now can reply by writing the answer to those questions, to the first question. But in general, we have very eligible and very high quality training programs, materials. If you want to do factoring, you can directly contact one of us, directly me or Spiros, and we can provide you with material and also the offer of the training programs. I would like to continue with the second question. How can DFIs, I think this means development financial institutions,
Yes.
yes, effectively identify potential factoring clients and assess their creditworthiness, particularly in emerging markets where information and data may be limited. Yes, this is a challenge, I must say. However, even in the most nascent market, there is always a way to find and reach out to the data. So, of course, there should be a kind of infrastructure. Therefore, there is big efforts and programs, projects introduced and performed by Afreximbank, and also together with FCI. We are trying to get help from central banks or from some credit bureaus, but if there are some information, lack of information or information scarcity, it is a way just directly to contact the enterprise, which means the buyer company or the seller company, to have to collect data from them. For example, myself individually, I'm also coming originally from a developing market, from Turkey. I used to work more or less 18 years in the real business in factoring market in Turkey. And at the very beginning of the factoring journey of Turkey, there was no place where we can have information from about the buyers and sellers. How we started? Usually we started as, first of all, the subsidiaries of the bank, and we started with working with the clients of the bank as seller and the buyer. And secondly, if the buyer and seller not a client of the bank, then we tried directly to approach these companies in order to get some information. But as the market has been developing, also the resources for information has also developed, like credit bureaus or other type of information centers established, and this is how it works. So you need to start from somewhere, and then the market starts to move on and to improve. There is the third question, the risks assumed with recourse and non-recourse is different. Yes, that's correct. What is the market standard interest rate for each type? It depends. Also, not only the market pricing here is important. Of course, the most important indicator may be the market price of the money, of the currency here. But secondly, the risk of the seller buyer, the risk of whether you can reinsure yourself with a correspondent factor, or the risk of the transaction. I have a second presentation in the second part of the webinar. There I will talk about these risks together with you. But in my personal opinion, if it is only with recourse, of course, you take a higher risk, and therefore the risk of or the interest rate or the pricing of this product should be a little bit higher than in case if you do a kind of two-factor business or trade credit insurance is involved in your risk mitigation. But sometimes in case of without recourse, you have to pay more for the commission because you have to secure yourself, and also in that case maybe the financing pricing should be lower, but the seller should pay also an additional commission for the credit protection for the buyer. Another question, I want to understand the role of FCI in the factoring process of a transaction. FCI is an association, or FCI is, okay, we can maybe find a similarity between FCI and ICC. For example, ICC is the center of excellence for letter of credit related transactions, and FCI is the center of business for open account trade type of transactions. FCI is an umbrella institution which provides to the members of FCI institutions some value propositions and some helps and assistance in terms of a legal scheme, in terms of one legal scheme, in terms of one communication platform, in terms of one society for memberships, and etc. Again, Spiros will have another presentation about this. If you become a little bit more patient, Spiros will explain everything. I understand, meanwhile, some of the questions have been replied by written. And okay, I don't see any other question. Thank you very much.
No problem.
For your patience.
Thank you. Thank you, Asian. I will read a few questions that are in the chat box so we can answer them. There are some related to the definition of the recourse factoring, but I think throughout the program, we'll come back to that. But one important question that I found here is that one of the challenges mentioned was IT and software to manage factoring transaction. Does FCI not have a cloud system member can use in different regions, particularly microfinance institution already dealing with SMEs in Africa? That is one.
Yeah. I will give very generic reply, but maybe so definitely Nasuru is the best contact point to ask this question. So FCI has many sponsors, which are the best of IT providers in the world, all around the world. If you check FCI website, you will see all the names, and all these IT providers are very good in their own field. Some of them are focused in the African market. Some of them are focused in the Middle East markets, for example. And this is one of the first options the financial institutions who would like to enter the factoring business, they can directly contact the sponsor institutions so they can find and get a lot of information, what is the best way and what is the best solutions for them. This is how FCI assists our members and non-members in the regions in terms of the technology.
Okay, yes,
Okay.
thank you. Just to add,
Yes.
FCI is an association, so we have our members. We have also some vendors who are our members. So, but if someone want a solution of the platform in the market, we have a lot of solutions depending of the products, depending of the reputation and experience. So we can have the smaller system where you can pay $500 per month. You can have a system where you are also paying $5,000 per month. So it's depending where you are. Are you a bank? Are you a microfinance? Or are you a small broker? So there's lots of solution of factoring solutions. So if you are interested, we can have a conversation about that. So we are able to advise you to have a proper system to run your factoring business. Thank you.
Thank you, Nasuru. There was another question on how can a financial institution become a member of FCI, but I don't think we will spend time on that. Maybe just liaise with Nasuru and he will provide you more detail. His contact information will be provided at the end of the session.
Yeah.
If you...
Yes, go ahead.
Yes, if you don't mind, we will continue with the second session too, just to avoid that a break can really maybe lead to people dropping out of the platform. And I think we're good to continue. I don't know whether there's any objection from the interpreter. I think we have a team that can really manage the situation. Maybe we move now to the second presentation. Can you take it as well, Mrs. Asian?
Yes, of
Or
course.
you
Thank
want
you
to?
very much.
Okay, let's move on with the second presentation. That will be on the techniques in structuring, factoring, and receivable finance transaction and the management of compliance, operational, and credit risk in factoring. You have the floor.
Thank you. One moment. I cannot make the slide work. Okay. Okay. Maybe it's good that we have just finished the products and how they work, and then we can talk a little bit about the risk management, because risk management is a little bit different. How do they do it? Maybe in traditional bank lending. In factoring, it's kind of tool that the operation of the system and the operational framework is a little bit more. We need to be more in as the financial institution in the trade and in the transaction flow. Let's think about which main risks can you identify in factoring. If you would like to interact with me, you can use the chat area. So please type there which main risks do you identify in factoring, or can you assume it can be present while doing the factoring business? I have explained all the products. I mentioned also from time to time, okay, this risk, that risk, and etc. But you may give us some examples as well. By the way, of course, the first main two risks are the seller insolvency risk and the buyer insolvency risk, because there are two main parties except the factoring company or the bank. The two other main parties are the seller and the buyer. The buyer insolvency is important because the factor is collecting from the buyer. In case of the non-recourse case of factoring, the buyer doesn't pay, is not able to pay, and the factor takes the risk, and the factor makes the payment under approval. So which means buyer assessment is crucial and buyer risk is very important. Seller risk also important because the business is initiated by the buyer, and in case of any reclamation, in case of any commercial dispute related to the goods, which has been claimed by the buyer after the advance payment has been financed, has been made by the factor must have a recourse back to the seller because the buyer will not pay. Why? Because there is a reclamation. The goods are damaged. The goods are not in good shape. The goods are delivered late. So I can multiply these excuses or these reasons. But in that case, this is considered as a commercial dispute, and the buyer is not obligated to pay. What will happen? The factoring company must have recourse back to the seller and ask the seller to recover, to pay back the advance payment. If the seller creditworthiness or the financially, if the seller is not sound, is not in good shape, then the factor will write a loss. Therefore, the seller's insolvency risk is also important. Before going into the business, the factors usually makes the assessment on both parties, in both cases, in non-recourse cases and also with recourse cases. In case of a two-factor business, where FCI scheme is in place, the export factor makes the credit assessment of the seller only, of the exporter only, because the buyer risk assessment is the obligation or is the role of the import factor. But these are two main risks. The third one is the dilution risk. Dilution is any deduction which is made or which can be made by the buyer legally, meaning that there is a dispute, reclamation, any claim, or there is any counter trade between seller and the buyer, or there is any discount to which buyer is eligible. So according to the contract, the buyer can make any deduction from the amount of the receivable. These all we call with the term dilution in factoring. So what is the dilution rate? This should be predicted, or this should be evaluated, calculated to the respective business before the factoring relationship has started. Operational risk is, yes, present, but operational risk is present everywhere in all type of businesses, not only in factoring, not only in financial business, but in all type of businesses, operational risk is present. Another one is the fraud risk. This is one of the important risks as well, because factoring is based on open account receivables, and as these are open account receivable, it is the most exposed way of trade which is open to fraud. Meaning that there is no commitment for payment, there is no confirmation of, or guarantee for payment underlying the transaction. And it is only based on the buyer's creditworthiness. And in case of the buyer doesn't pay, then the factor pays. But why it is open to fraud? As it is an open account case, it is easy to fraud the seller by the buyer, by the seller, by a third party, or by a collusion between seller and the buyers. I will come to that detail in the coming slides. Then there are other generic risks which you may encounter also, which you are exposed also as a financial institution. Legal and compliance risks, political, country and transfer risks, regulatory risks. If your industry is regulated by an authority in your markets, in your countries. And final one is the reputational risk. But if we come back, if we conclude, or if we summarize again, the main risks in factoring, not the generic ones, seller insolvency, buyer insolvency, dilution, including the disputes, and the fraud risk, with a little bit in addition, the operational risk. Before going into the details of the risks, I would like to make a stop and to talk together with you the most suitable business for factoring. If you, or if we don't select the most suitable factoring business, most likely we will encounter a higher risk of dilution, a higher risk of dispute, maybe fraud, seller and buyer insolvency. Now, I would like to talk with you a little bit about what are the characteristics of the most suitable business for factoring. First of all, sales must be on open account terms. We already explained what does it mean open account. Sellers must be, or should be, as much as possible, financially sound companies with acceptable level of factoring turnover, meaning that factoring is not a transaction or not a business which is acceptable only for one invoice. Factoring business, factoring turnover from the seller to the factor should be continuous and growing one. Buyers should be creditworthy commercial companies. The goods delivered or the services performed must be sell and forget type, meaning that the seller sold the goods, the buyer bought the goods, and maybe the buyer is a supermarket chain. When you go to the supermarket chain today, whatever products you see on the shelves are sell and forget type without long-term warranties. So you buy soap, or maybe you buy a package of sugar, or you buy anything from the supermarket or over-the-counter type of goods are sell and forget. So there is no long responsibility for the buyer behind of the goods. There is no responsibility for the seller behind of the goods. This is what the most appropriate and suitable type of goods for factoring. There shouldn't be contractual features that reduce the value of the receivable. Why? Because the receivable itself is the collateral for us. And definitely we don't wish the receivable get reduced their value during the lifetime of the transaction until the due date of the transaction. Therefore, it is #1 criteria. It's a must for the financial institutions to ask the seller and the buyer to provide the contract they signed. Sales contract, buyer's contract, purchase contract, whatever it is, you should receive that and check, review the conditions and the clauses inside to find out whether there is any clause or condition inside which may reduce the value of the receivable for you in the long run. There should be a good proof of delivery system, whether late delivered or whether not delivered or whether it is delivered to a third party. So there should be a proof always for it. The factor should look for a good spread of debt, meaning that you are working with one single seller and this single seller has only one buyer, which means 100% of the risk is on one buyer, which is not good for the risk mitigation and risk diversification. The factors prefer usually one seller works with minimum 5 buyers, and the risk of one certain buyer in the total portfolio doesn't go up than the 30% of the total buyer's portfolio belonging to one single seller. And the final one, the turnover should be a growing one and should not be seasonal one. So the turnover should not be accumulated. Risk should not be accumulated in the same period of the year. What are the sectors which could be subject to factoring business? So the left one, wholesale type of businesses, are the most appropriate ones. Underneath, you see fast-moving consumer goods. Fast-moving consumer goods, again, any type of goods you find in the supermarkets, all type of retail goods, over-the-counter products, toiletries, beverages, and etc. Clothing goods, apparel business, textile business. Home appliances, any type of home appliances you can use at your homes, fridge, refrigerators, washing machines, or dishwashers, or electronics, consumer electronics, TV sets, maybe even laptops, computers, and etc. Coming to manufacturing industry, any type of goods which can be manufactured and sold in pieces. Metals, chemicals, automotive industry is a good example, and other type of raw materials. Not only tangible goods, not only solid goods, but also services can be subject to factoring, like IT services, software products, marketing services, HR, recruitment services, transportation services, and logistics services. What about the other industries, energy sectors, construction, public sectors? These three may have some additional risks because these are not sell and forget type of goods. These are mostly services. Therefore, those type of factoring business include additional risks for the factors which should be known by the factor, to be aware by the factor, and should be known by the factor how to mitigate those risks, how to manage those risks. Some good examples, so appropriate goods for factoring. For example, dairy products producers selling to a food retailer, to a supermarket. Chemicals for the production of plastics. HR company recruiting staff for a big corporate. This is a service factoring case. Construction business, but these are more risky. For example, historically or statistically, there are not many factoring companies dealing with the construction business, building construction or road construction, because this is not sell and forget type of business. it depends very much on the buyer's approval that the goods is complete, sorry, the construction is complete and in good order and etc. So it is open to a high level of dispute. Therefore, it is referred by a few number of factors, but for example, like in Americas or in other advanced countries, good developed countries, there are factors they are dealing with construction business, but they are experts in this business. So they know what are the risks and how do they manage those risks to mitigate those risks. Another risky business is vegetables, so fresh vegetables, fresh fruits, fresh flowers, fresh fish, because these are so-called perishable goods. These goods can be damaged easily during the transportation, and therefore these are some risky businesses. What are the management of operational risk, credit risk, and other type of compliance risk in case of factoring? First of all, let's try to understand what are the areas of the business risk in factoring case, in factoring transaction. Maybe in traditional bank lending, there is one way risk, which is the client risk. There are other risks as well regarding industry, maybe who are the other parties in this transaction. But in factoring, there are 4 different corners, mainly 3 different corners, but additionally, in addition, the fraud risk is the 4th corner or the 4th area of the business risk. First, we have to evaluate the seller risk. Here we make the assessment of the financial risk of the seller, industrial risk of the seller in which he is operating, the product risk, what is the product itself, and the performance risk of the seller should be evaluated. When it comes to the debtor risk, here, first of all, the credit risk, whether he is able to pay, in other words, the financial risk. Then the diluted risk, what is the capacity or the potential probability of the buyer to make discounts, deductions from the payments historically. What is the level of the dispute risk? What is the level of the dispute in this between the seller and the buyer? These are information you can collect directly from the seller. And what is the concentration risk of the specific debtor in the portfolio of the seller? It is the one and only of the debtor for the seller, then it is huge risk. Or it is just one of the 10 buyers in the seller's portfolio. Then we should evaluate the risk of the transaction itself, the risk of the outstanding receivables, whether the receivable is subject to ban on assignment, whether there is a prohibition of assignment implied by the buyer on the receivables, that in that case, it is not possible legally to get the assignment of the receivable from the seller, whether there is a risk of multiple assignment of the same receivable to more than one assigners, whether there is a buyer concentration risk in the receivables risk, whether there is a contractual risk, or whether there is a country risk. So from which countries the collection to be made, from in which countries the buyers are based. And the 4th area is the fraud risk. What is triggering the fraud risk? First of all, if the seller and buyer not in good shape, creditworthiness, meaning that, then they could be more tended to attempt a fraud. But other than this, if they are related parties, for example, seller and buyers are sister companies. Seller is the parent company, buyer is a branch of the parent company. Or even further, maybe they are not directly related companies, but they are inorganically related. For example, the management board of the seller is also the members of the management board of the buyers, something like this. Or they are relatives, they are from the same family. So I can multiply this type of examples. It is therefore important to understand beforehand whether there are relationship between seller and the buyer. Otherwise, it can be a way, it can be a sign that can be a collusion between seller and the buyer. In international factoring, in case of the two-factor system, in addition to 3 main risks, you see here a 4th one. So the first risk is the performance risk of the client. The second risk is the payment risk of the buyer. Fraud risk is the 3rd one. And the 4th one is the counterparty risk, because here there are 2 factors. And like in the financial institutions business, like in the FCI business, the import factor and the export factor should evaluate each other and should make the assessment for a credit limit for each other. This is what we call also counterparty risk. Seller selection phase is the first phase and the most important phase of the credit management in factoring, because if the factor selects a good seller, then the rest of the business will continue with less risk. This is why we assign a lot of importance to the seller selection before onboarding the potential seller. Here we have 4 important criteria, 4 important checkpoints to ask ourselves, or to make the checklist, to fulfill the checklist. The first one is the assignability of the receivables, whether the receivables are legally assignable. And here we are checking whether there is any ban of assignment or prohibition of assignment imposed by the buyer, or there is any other pledge or any other assignment which has been already put over the receivables by any other 3rd party, maybe by a bank or by any other institution. If there is no problem legally with the assignability, then this receivable is assignable, the first green check. The second one, we should find out whether the receivables are collectible legally and commercially. So because ultimately, in case of a domestic business, we are going to be the owner of the receivable. In case of a 2-factor FCI business, the import factor will be the owner of the receivable, and these parties will collect from the buyers. Therefore, it's important whether there is any legal constraint, any legal condition which are prohibiting or which are maybe preventing the collectibility of the receivables. This is something we have to check together with the buyers and with the sellers. Viability is about the integrity and the creditworthiness of the seller, and adequacy is whether the factoring product, because there are different factoring products, and also under factoring product there are different services. It is up to us, after all these assessments, which product and which services we are offering, we are going to provide to our potential client, whether what we are going to provide is really adequate to the needs of the client. This is the 4th checkpoint. If the answer of all these 4 checkpoints are a green check, then we can understand that this business is a suitable business and these receivables are factorable accounts receivables. For the seller risk, you have here a list what needs to be checked. From now on, all the slides is like a book for you. You can download, you can make the printout, and you can keep on your desk if you will be involved in factoring business, what to do to understand, to evaluate the seller risk, take the financial risk, product and industry risk of the seller, performance risk, commercial dispute risk, and the collection and settlement risk. About the debtor risk, buyer payment default is the most crucial one. Dilution risk is the second one. For having an understanding on that, you need to check the contract signed between seller and the buyers, and finally the litigation and the dispute risk. Here it's important to understand again, based on the contract, if there is any counterclaim or set-off is possible between the buyer and the seller, which leads to a dispute in the end. For checking the receivables risk, here these are the criteria for the checklist: a buyer concentration level, the country risk of the buyers or the country risk of the products, if the seller is a trader or reseller, for example. Again, to understand, to evaluate the industry risk, check the contract risk, dilution, what is the amount, what are the number of credit notes or bad debts in the most recent past, and whether the buyer-seller relationship is a strong one, is a weak one, is a very long established one, or is a very new one. For example, if it is a new one, which is more open to risk between seller and buyer, which is also means more risk for the factor, but it is a longly established, a lengthy relationship which is going smoothly, then this business is less risky business for the factors. Just a simple example. A little bit about the fraud risk in receivables finance. We said it is an ever-present risk for receivables finance. Why? It is a key vulnerability because factors are financing against copies of the invoices, especially where the technology is very much improved. And if the banks are working with high technology, it's barely to see the hard copy of the invoices or hard copy of the other documentation belonging to the transaction. And everything is digital copies, e-invoices, electronic messages, and it is therefore the more likely that the fraudsters can defraud with electronic invoices or electronic messages. However, in markets where factoring is new, in emerging markets, for example, or in developing markets, I strongly suggest not to start directly with digital solutions. Maybe not for all transactions, but from time to time, randomly, ask your clients to bring you hard copies of the documentation, because it is not only you should ask the invoice, you should see the invoice, whether the assignment notice is already put on the invoice. You should ask also the shipping documents. You should maybe compare the shipping, items on the shipping documents together with the items on the details of the invoice. You should ask order slips or the delivery slips. So there is a set of the documentation the operation department should ask to control, and then to send the advance payment to the seller in order to prevent not only fraud, but only the dilution and also dispute risk. When we come back to the collusion, sorry, to fraud, here you see a kind of examples of fraud in factoring. Maybe one of them is the over-invoicing. The unit price is XYZ, and the seller is selling 100 units, and the unit price should be XXX, but he makes over-invoicing, and he writes on the invoice rather than XXX, XXX, it writes XXXX, so 4 times. So meaning that it is an over-invoicing in order to get more financing from the factor, but on the date of the payment, the buyer will pay, of course, the real amount of the invoice, and the seller probably will send a credit note just to make the set-off for the overpayment. So this is a way of the frauding the factor in order to receive more amount, so higher amount of financing. Another example is fictitious invoices. Fictitious meaning fake invoices. which is meaning as well, there is no underlying transaction of the invoice, or shipment has not been realized yet. There is no goods shipped yet, but the seller is in so desperately in need of cash, and therefore he is issuing a fake invoice in order to receive finance from factor. Multiple assignment and extended payment terms are can be counted to other reasons. What to do for risk mitigation? This is the seller assessment framework, and again, everything is in a nutshell here. This is for the seller assessment, seller selection, industry product evaluation, and receivables portfolio evaluation and risk assessment. One by one, each item, each bullet point tells us what to check, what to evaluate without missing any single point. This is a page about what to do for risk assessment, risk mitigation for the debtors, for the debtor evaluation. Financial assessments, net worth, profitability, to evaluate the litigation risk, dispute with the seller, dependency of buyer on the seller, types of the buyers, big buyers, small buyers, and just in case, if required, then please try to find the ways for third-party risk mitigation. As said, you can use insurance or interfactor, the two-factor system, or you can ask the parental guarantee from the seller or the buyer's company. And risk mitigation graphic, so to say, for the receivable assessment framework, checking portfolio of the buyers. But what you see here, you don't do only one time before you onboard the buyers or before you start the business. In factoring, there are two phases of risk management. First one, before onboarding the seller. Second, it is a continuous monitoring, continuous risk mitigation assessment after you have onboarded the seller and after you have started receiving assignments, receiving collections, making payments, taking, maybe receiving disputes, and etc. So this receivables assessment should be done in each and every moment of the lifetime of the business. Checking portfolio of the buyers, control of payment, buyer control, all what you see here. And therefore, to do that, you definitely need a very good IT system. You cannot do continuously ongoing that type of risk monitoring by hand, by manually, or by humans. Definitely, you should have a kind of, I'm not talking about a very sophisticated IT system, just one simple risk monitoring module. Use it definitely, let it populate reports periodically, and then make the interpretation and comments on those reports, what is not going in trend, because those reports show you clearly where are the pain points, where are the changing trends, where are the changing behaviors by the seller, by the buyer. Then based on these points and indicators, you make some action plan in order to mitigate the risk. Second component, which is also very important, next to the IT system, is execution of field audits regularly. Meeting directly the sellers, meeting directly the buyers. This is very important, because if you just ask financials and ask documentation, and if you do all your assessment and monitoring directly in the bank, then you will miss definitely very important signals. However, by visiting the factories or the plants, the workshops, meeting the management or the teams, you will hear a lot of important information, and then you can combine and compare what you have heard or what you have spotted, what you have noticed on site, what you have seen directly on the papers, on the documents at the bank. And here on the last slide, you see just some examples, some recommendations. What should be the risk triggers in the IT system for monitoring and reporting, and what type of actions you can take in order to mitigate or just recover your risks before they get realized. Very quickly, operational risk in factoring. There are 4 main items here: the people risk, process risk, technology risk, and the legal risk. People risk is just directly your staff. To mitigate the people risk, the best way is continuous training of the staff, because it is not a one-way stable business. Business is changing, markets are changing, the way of doing factoring business is changing, risks are changing, fraudsters are changing. Therefore, it's very important to provide continuous training to your staff who will be involved into this business. Process risk, you should write your processes, you should write your procedures, and from time to time, you should update these procedures and processes. Technology, more or less the same. The technology risk is everywhere. You can be hacked, or there can be some malfunctions, some IT risks, but it's important to set some precautions and measures before it happened. Legal risk is important in factoring or in receivables finance business. The legal risk may be caused by the non-compliance with the law and regulations. This is very important. Wherever you will be based, please check the jurisdiction first of all. What are the rules, norms, standards? What are the law? Whether there is a standalone factoring legislation in your country where you are based, where the seller's country is based. What should be the factoring terms? What are the insurance policy terms if you work together with an insurance, and whether the insurance policy terms are reflected or can be reflected in the factoring contract terms. To understand very well the local civil law and the commercial code in order to ensure the validity of assignment of the receivables. If you are dealing with the third parties, what are the rules of the correspondent factors? What are the rules of FCI? For example, what are the contracts rules of the insurance companies? And if there is a regulatory framework regulating factoring business in your country, then you should understand very well and comply with the rules of the supervisory board, whether you should have sent reports from time to time. You should deal with that as well. But this is ultimately important in order to avoid the legal risk and ultimately the reputational risk for a factoring company. My last slide, risks in reverse factoring. We had a very good look in the risks of the traditional factoring. In the reverse factoring, the main and the biggest risk is the buyer's risk. So it is very simple. So the risks in the reverse factoring is very simple. Why? Because the suppliers are onboarded, but as the buyer is giving a payment commitment without recourse, we provide as the financial institution directly the purchase price. We pay it to the supplier, and we don't have a recourse because this is an irrevocable type of financing. Therefore, there is no supplier risk for the bank, for the financial institution in this case of factoring. But there is a very big buyer risk. Why? Because 100% concentration is on one single buyer. the risk is not diversified, is not shared on various numerous suppliers or on various numerous buyers. There is one big single buyer. Okay, as the buyer is very big, maybe we can think, okay, the buyer is big, risk is big, but buyer is such a strong entity. It is very small risk that he fails or he defaults. But unfortunately, if that happens, then the financial institution writes a very big loss. This happened very recently in the past 2 years, Green Seal case. There are other cases, for example, one single big buyer in reverse factoring case bankrupted. And unfortunately, there were a lot of financial institutions financed the suppliers based on the risk of the buyer, and they unfortunately dived in big losses. As you see here on the arrow, the concentration risk is the highest. There is low capacity, low potential of collusion risk and the fraud risk, which is present everywhere, as I told you. Maybe the buyer can be colluded with some of the suppliers, but this is less likely. But the biggest risk is directly the buyer's bankruptcy, concentration risk, and in addition to that, this is also generic, everywhere is possible and present, the market risk, regulatory risk, and the cybersecurity risk in reverse factoring are present. I would like to make a stop here. This is the end of my second presentation. Thank you very much for listening to me.
Thank you very much, Aish. Yes, thank you, Aishin. And it was quite, it's not easy for you to take 2 presentations back to back. I think it's very good and useful when you are really discussing business making, promoting a business, and all the benefit that are attached to the business. Also to show that on the other side of the picture, which are the risk that is also associated with that business, so people can see it, the 2 sides, I mean the profitability and the risk that is there, which actually does not, it should not be seen as something that really prevent institution really to enter the business, but they just need to be mindful of all these risks that are attached to this type of to this business line. I will now invite Mr. Spiro Solis, who is the Deputy Director for Education at FCI, to take the next presentation. That is it's on the key success element in setting up factoring activity, the role of FCI and advantage of FCI membership. I think that really address some of the questions that we have received in the chat box. I will also encourage the participants to continue submitting their questions in the Q&A box so that we can keep track of them. And if those who cannot answer, maybe we can follow up afterwards some way. Thank you, Mr. Spiros. You have the floor.
Thank you, Hughes. Thank you very much, everybody. And allow me just to continue with mentioning a few. It's like sharing best practices in a way that is derived from FCI's 50+ years of experience in supporting emerging markets, setting up factoring activities. And we'll go through a few topics. Some of them were already mentioned, but let's sum up. Let's have it in our mind. So once we decide to prepare a business plan, this can serve also as a guide on what the steps are and which areas do we need to address. Now, first of all, I think it has been mentioned both by Mr. Mulroy, Madame Marwani, as well as from my predecessors, that really the legal and regulatory environment in a country is of vital importance. And when we speak about legal and regulatory environment, without going into strict details, I think what we need to do is just ask a few questions, okay? Now, first of all, you need to see whether there is a loan factoring, and we will refer to the loan factoring, or whether there is a reference on the assignment of receivables in civil law or commercial law. As we will be taking receivables as a kind of collateral, this is the asset that we are financing. We need to be able to ensure that this transfer of receivables, the assignment to us, is secured, especially in case of insolvency of the client, that we are able to present this document at the court and this be an executable title. And this drives me to my third item here, whether there is a favorable legal framework to collect receivables through the court if necessary. I hope that will never be the case, but you never know. We need to ensure that receivables are presented in a, and the debt is recognized by the end buyer. And finally, I think this was mentioned about the credit information availability on buyers, and not only the information availability, but reliable information and availability on buyers and sellers, especially the financial, because when we analyze that risk, this is one of the main parameters we need to rely on, not only the historical transaction part, but also in the financial standing of the buyer. Now, we're talking about the specific factoring law, and I can name a few countries more advanced in factoring and receivables finance that really they have progressed very successfully without having a specific factoring law, like Germany, for example. In my country, where I come from Greece, factoring, we do have a specific factoring law, and as well as other countries. And what are the advantages? Okay, let's see if you of them. So first of all, you have the certainty that there is a law, there is a specific reference point, okay, and it combines all applicable law related to such transactions in one document. Okay, in many cases, this law is updated, adding modern international practices. During the build-up of the law, factors can input, can participate in the building of this law along with legal experts. It is also easy for the judges, for all stakeholders in this process, which are the judges, the clients, the debtors, to understand, okay, without having to deal with expensive law offices and trying to understand how factoring works and which different articles and different laws are referring to that. It avoids reliance on unwritten business customs, okay? A law is a law, it's black or white. It doesn't give any room, it should not give any room for misinterpretations. And finally, all parties' roles and responsibilities are clearly defined. Therefore, they can be confident of their position. But what also we need, it's not only the legal framework to exist, but also we need also a well-functioning court system with knowledgeable judges to enforce this law. Because even in my country, we have factoring law for more than almost 20 years. Even now, when we need to go to a court and present a document, an invoice, and we need to go from the beginning and explain to the judges what is factoring, how it works, everything, because they don't have the knowledge. Hopefully, there are not so many cases, which is good as well. But really, we need to have a well-operated functioning court system. A few other things that areas that we need to also see are government regulations, and here I have listed a few items we need to pay special attention to when you're trying to build our business. Like, what are the qualifications to be a factor, to establish a factoring company, registration and licensing, public registry of factoring assignments. This is something very important. Allow me to come later on with a specific slide and highlight the importance of this item here. Qualifications for shareholders. Who can be the shareholders of a financial institution dealing with factoring? Access to money markets, okay? Foreign exchange, for example. Qualifications for the senior staff. In many countries, there are some specific qualifications in order to be a C-level executive in such organizations. And of course, sanctions for non-compliance with rules and regulations, anti-money laundering, and all these. So all these form the kind of legal framework that we need to explore further and have a legal interpretation of most of these items. I refer to the public registry of factoring arrangements. Okay, what we mean by that, it's a kind of central receivables registry, like a recording center. Okay, where all factors, sellers, buyers are registered, and also their receivables. And this provides very big advantages to the factors. First of all, it prevents double assignment and financing. With this framework, any seller who issues an invoice, and in today's world, we can imagine that most invoices are connected, interconnected with the VAT systems of the government or the IRS or different organizations in each country. It is there. It is accepted by the buyer. That involves a seller and a buyer. Therefore, the factor is ensured that he's financing a real underlying transaction. Okay, as I said, it works online. It can verify the ID and VAT of sellers and buyers. A few other items here that are possible. But if you're in an emerging country and if such infrastructure exists, so electronic e-invoicing, it is the best thing to do to establish, along with other financial institutions, a kind of receivables central registry so that all receivables are there. So before a factor finances a receivable, he is able to know whether this receivable is real or whether this receivable is already assigned to another institution. This could be a bank, like a pledge, or it could be also another factoring company, in order to avoid any fraudulent activity by the seller. We as FCI were now participating, and now you see a picture here of Mr. Mulroy. You recognize that with UniDroit in the factoring model law project. And what we're trying to do is to build and prepare a law on factoring and receivables finance in order to be applied in all circumstances. Of course, I should also highlight here the importance of Afreximbank and the lead that Afreximbank took in establishing and preparing and establishing a factoring model law for Africa, and many factoring countries, many African countries, apologies, have already ratified that, and in many of them that is already in place. Moving away a bit from the legal part, let's see also other items and other research we need to do when we talk about the establishment of a factoring corporation. The macro and micro environment analysis. GDP, okay, industries, sectors. My colleague Aishan before, she made some good references in some sectors in globally that are more favorable to for factoring. Of course, everything has to be on open account sales, but also a sector analysis is also very important. SMEs and the financing gap. I think that this is evident, especially in the African region, that there is a very big financing gap, but this is also good to explore, and whether if there is a financing gap, then how the factor can really fulfill that gap. The financial and banking sector analysis is also very important. Factoring competition. How is the market structure when you want to establish something new, as well as with banks. If you're a bank, of course, this is a kind of internal competition. But if you are a separate financial institution, what are the competitive products of on trade finance that the banks are offering, and how you can position your services, the factoring product in the market. When it comes to organizational structure, now here we have a few options, and it depends on who establishes the factoring corporation. A factoring corporation can be established by a separate shareholder or a financial institution, but also for a bank. Now, the most common structures that we see are separately incorporated companies. It can be a bank subsidiary, 100% bank subsidiary, okay, but working independently and outside the banking operations. It can be a division of a bank or a financial institution. So again, within the framework of the bank, under the scope of the bank, but like a separate unit within the bank. And the third, which is not met very commonly, and it is the least preferred because of complications, is they integrated into the bank activity. There, in most cases, there's a big confusion of how factoring works, and there is not a very clear understanding of the commercial approach and the transactional risk management approach that factoring has in trade finance. When it comes also into internally, we need to think about business development and marketing, and this strongly depends, as we said before, on the macro environment. But allow me just to highlight 4 main items here. We can explore the possibility of direct sales, which are relatively lower cost and directed to targeted clients. Digital marketing nowadays is very popular, targeted campaigns, social media and websites, and this is what we need, especially in emerging markets. We all make use of social media, and a nice website is really very attracting, and in the website should be something like a landing page. You need to collect information, so to create the leads. Introduction by real users. So the real users, the clients of factoring, can really be the best reference because they share their best practices and good experience. These are very powerful and valuable statements, and of course you can have a kind of rewarding scheme for successful introduction. And finally, when your factoring unit is strongly related or directly related to a parent bank, then you can take advantage of the parent bank's network for lead generation. And in FCI, I'm sharing just a statistic with you here. FCI members declare that they received 70% of their new businesses from their parent banks. When the case is, I don't speak if you're a totally independent financial house offering also factoring, but whenever there is a parent bank present and you're working either inside the bank or independently like a separate company, but you belong to a bank, most of the business you can take advantage comes from the parent banks. And this is something very important. It creates easy lead generations because the bank already has a lot of information on sectors, on different industries, and definitely on clients. We already highlighted the importance of IT infrastructure. I think there was also a question, my colleague Aisha mentioned that, and we will be talking about that. We will be stressing the importance that whenever you want to establish something new, you need to have a proper IT infrastructure, even if it has the minimum requirements, the minimum capacities. Still, it has to include some main features like invoice processing, collection process, and others. Seller and buyer reports. Aisha talked about the risks involved, and risks can be identified by using proper reporting. Management information reports for strategic business management, as well as interfacing with other platforms and local systems. This is also the case when you are a bank and you're introducing factoring. The two systems need to talk, need to speak with each other to identify potential exposures and risks. All right. Of course, I represent the academic part of FCI, and I couldn't exclude from my slides the human capital. And what I need to state here is that education and training are very important. And I think that before you start anything, you need to invest in capacity building. And this is something that we do here as well right now with all of you. We're trying to educate and create awareness, but capacity building is very important. And why is it important? Factoring is not like all the other products, okay? Factoring has a very specific operational mode at all levels, starting from business development, going to risk assessment, as well as seller and buyer monitoring. And it is very important as well to understand that all aspects of factoring through a cohesive learning process, including sales, risk, and legal processes. Okay, this is something that with the support of the African Development Bank, AADFI, and Afreximbank, we as FCI Academy and FCI, we are investing heavily in this area, and I will have the opportunity to refer to that in my in the second part of my presentation. A few more points just to consider for your consideration. Okay, just take these also, think about them when you are setting up your business plan, managing the credit risk, the buyer's credit risk, whether you can use the own risk or you can use the credit insurance, when and where credit insurance is available. FCI membership. We mentioned that FCI has a specific operational framework for cross-border transactions, as well as capacity building and shares industry expertise. There is a lot that you can take by a membership in FCI. You can also engage consultants. There are people, very experts out there that they are subject matter experts and they will be able to share their best practices and valuable knowledge with you. And finally, of course, you need also to be able to comply with the strict regulatory frameworks that nowadays exist about anti-money laundering and other related items. And a few more challenges that you will be facing, trust me, you will be facing, and we're still facing them, whether we are working in emerging markets or even in mature markets, are the absence of knowledge of the product by legal people. We highlighted that also before. Overcoming public misconceptions that in many cases, I think I also saw a comment about South Africa from one of the valuable under this here, lenders of last resort. Okay, this is a misconception that needs to change, because we need also always to remember, and this was highlighted in previous presentations, that factoring is not only finance. Factoring is a set of services. Finance is the main, but it's not about finance. This is why it makes the product more complicated. This is why the product is a bit more expensive. Okay, not always the case. Someone can argue that, of course, in emerging markets can be more expensive, where competition is not so fierce yet. But in more emerging in mature markets, trust me, factoring is not so expensive compared to traditional bank lending, because of the competition that exists also there. So it's in our benefit to increase the number of players in the market and increase competition and also offer good services. There is a lack of trust in new players when you're entering a new market. Still, people will be in the business community will not be so not happy, but willing to directly cooperate with you. They may be more reluctant, and they will be probably waiting to understand more. And finally, even within our organizations, when I say our organizations, I mean banks, okay, financial institutions, when we try to establish something, you see some reluctance there, because they can view factoring not as a complementary product, but mainly as a competitive product, and not necessarily from the top management, but from the other trade finance divisions. And this now gives me the opportunity, having presented to you all the challenges and how we can build something, to see and inform you what we as FCI can do, what are the advantages of FCI membership, what you get. And one of my basic slides is this one, just to understand. Of course, you saw the video. Nasuru gave a good overview of what we do in FCI, but think about these 6 pillars. Okay, we develop and promote rules for cross-border factoring. We develop systems. We have a communication platform called AADFI Factoring, and this is for supporting our members in their international factoring business. Education, I'm going to talk in more details on that. Marketing and promotion, information sharing, statistics, industry white papers, and of course, we influence and lobby. We work very closely with international organizations, development banks, like we do with Afreximbank and the African Development Bank and AADFI, to influence and lobby to promote factoring globally, and especially in emerging markets. We connect. I think I should mention about international factoring, okay? And it is evident that risks in international factoring are higher for a seller, because he sells to someone who is located abroad, okay? And of course, one of the biggest challenges is whether he can increase the sales or take more buy risk. He needs to know more about the various legal systems and trade customs, how he can manage the delays in payment and commercial disputes. So the exporter really faces several challenges. And here it comes FCI, especially when you're starting and your business. It is good to start, I wouldn't say like in a safe mode, but in a safer environment. And my colleague Aishan showed you previously the scheme, how FCI works. I'm just presenting this with another scheme, not going into the details, but of course you will be able to review all these later. But this is a very, what I want to stress here is that this is a very convenient, it's a very solid, operational and legal framework, working for more than 50 years, having real proofs that the system works fine in terms of business. Business is increasing. We follow the trade flows from east to the west and vice versa. We have approximately 400 members, and allow me just to go to the next slide and inform you that we are represented in 94 countries. Okay, so your exporter, your potential exporter has access in all these countries through our correspondent network. We are minimizing legal issues because we have built our own rules, which are very clear and straightforward, the so-called GRIF, General Rules for International Factoring, and where the role and responsibilities of export and import factors are specified. The collections problems are minimized because you are assigning all these services. You are outsourcing this to your import factor correspondent, who is usually located in the country of the buyer. So for example, if your exporter has export sales in Germany, then the German correspondent, you will collect the funds from the importer. He will follow up for any pending issue, and he will try to solve any dispute that it can exist. They also check credit standing. They provide credit covers. Of course, what you need if you serve as an export factor is to check the due diligence and the financial standing of the import factor. It's like this, it is the same like we do in correspondent banking. Those of you who have such experience, you know very well that when correspondent banking, we cannot just apply for an LC and LG to be issued from any other bank. We need to make an assessment on that financial institution. And of course, AML nowadays very in the top lists of all financial institutions. High risks are there, especially in close-border transaction. So anti-money laundering risk is something that we take very seriously into account. When you join, for all the parties, for the seller, for the buyer, for the export and the import factor, there are very specific advantages. I'm just listing here some of them. For the seller, your client, who is also an exporter, there's one export factoring agreement which covers the credit risk of buyers in several countries. He doesn't need to have separated factoring agreements. He communicates with you, which is in the same language. He doesn't need to call the buyer, especially when there's a new buyer. Collections, sales ledgering, this is outsourced, as we said, by the factors in the buyer's country. So the seller focuses on his core activities. He doesn't need to be familiar with trade, or he doesn't need to be familiar with the trade or law of buyer country. There's a typo here. I'm going to correct that. Apologies. And of course, it obtains credit information on the buyer, but also for the importer who is located in the other country. He communicates in his local language because the factor or correspondent factor is based in his own country. He can pay invoices locally, okay, in the most efficient and cheapest way. And he is also able to trade in open account terms and avoid the cost of letter of credit. Remember, factoring is about open account trade, no LC, no cash. If you're serving as an export factor, you're offering your seller export factoring without setting up an operation in a large number of countries. The credit risk on the buyer is outsourced to the import factor. So he takes the credit risk of the buyer. So in case of buyer's default, he will pay, he will indemnify you. The import factor also performs the collection. You don't need a multilingual, probably, team working maybe 24 hours a day, because imagine of having buyers located in countries where time difference is like 6 or 7 hours, either ahead or back. And of course, if necessary, the import factor is taking legal action against the buyer. This is also very important. If it comes the case where you are working as an import factor, of course, you are taking all these risks once you have correctly assessed this risk, but you are also able to generate business, the correspondent factoring, and also increase the portfolio of your buyers. So there are definite and very straightforward advantages for all the parties involved in an FCI two-factor international factoring transaction. FCI has a very solid legal framework consisting of its constitution, of course, the interfactor agreement, which is an agreement governing the relationships between the two parties, the export and the import factor, the general rules for international factoring. Recently, we have built the general rules for reverse factoring. We are also having a new business line, which is for international cross-border reverse factoring transactions. We have arbitration rules, and those of you who are dealing with ICC, you also know that ICC has also an arbitration tribunal. We also have arbitration rules, and finally, because of our system, we do have the business rules and the straightforward AADFI factoring rules for the communication platform that we are using. Educate. It is one of the main pillars of FCI. FCI Academy is the center of knowledge for receivables finance. And today, we are really very proud to be able to offer a broad range of our e-learning courses. We are a mentor in the receivables finance education, and all, if not all, most of our offers are highly digitized. E-learning platform, we have online trainings and webinars like the one we are doing now. And we are supporting the industry to grow across the globe in all these countries that FCI is present, and not only, because we are also going to countries that, along with development banks like Afreximbank or with other regional banks, in countries where factoring is not yet introduced, we don't have still membership, but the country has a great potential. And at this stage, I would like to ask the support of my good colleague Gwendolyn. Let's watch together a short video about FCI Academy and its offerings.
Bienvenue à FCI Academy, la plateforme d'apprentissage de FCI pour les programmes de formation en ligne et sur site. FCI a été créé en 1968 sous le nom de Factors Chain International. Aujourd'hui, FCI est l'organisme représentatif mondial pour l'affacturage et le financement des créances commerciales à compte ouvert, domestiques et internationales. En tant qu'Académie FCI, notre objectif primordial est de fournir un apprentissage de haute qualité sur l'affacturage et le financement des créances à la communauté financière et commerciale mondiale. Plus de 10 000 étudiants ont déjà bénéficié de leur participation à nos programmes d'apprentissage numérique au cours de la dernière décennie. De plus de 5 000 délégués ont eu l'occasion unique d'assister à nos événements de formation en personne, à nos séminaires ainsi qu'à nos webinaires, en apprenant directement auprès d'experts de l'industrie et du réseau avec des professionnels de l'industrie. Nos collaborations avec des institutions académiques internationales fournissent à FCI Academy une accréditation et une reconnaissance mondiale et garantissent en permanence la plus haute qualité de nos programmes offerts aux participants. Nous sommes le partenaire éducatif de confiance des banques commerciales et de développement, banques multilatérales, des entreprises, les associations industrielles et les universités soutenant leurs efforts avec les outils de formation de FCI Academy pour établir un cadre fertile et efficace et renforcer les capacités pour l'affacturage et le financement des créances. Nos méthodes et nos programmes personnalisés localement se sont déjà avérés très efficaces pour éduquer la communauté financière et commerciale locale, y compris les régulateurs et les banques centrales. FCI Academy est une source ouverte de connaissances pour toute personne, organisation, institution financière et entreprise qui souhaite en savoir plus sur l'affacturage et le financement du poste client. Par conséquent, nous proposons des formations en ligne spécifiques et ouvertes à tous pour les acteurs de l'industrie et d'autres professionnels. L'introduction à l'affacturage et au financement du poste client, un cours d'entrée de gamme conçu pour tous ceux qui souhaitent en savoir plus sur les bases de l'affacturage et du financement du poste client. Les professionnels de divers secteurs et les étudiants universitaires sont parmi les participants les plus appréciés du cours. Les principes fondamentaux de l'affacturage domestique et international, un cours de niveau de base, est approprié pour le personnel débutant et les nouveaux entrants dans l'industrie de l'affacturage. De plus, nos programmes de certification offrent une formation ciblée sur des sujets spécifiques liés au financement du poste client, la formation de professionnels impliqués dans les fonctions juridiques, de gestion des risques et de vente et marketing grâce à une combinaison des cours sélectionnés. En outre, 6 cours sélectionnés autonomes ont été conçus pour ceux qui souhaitent recevoir une formation courte et ciblée sur des sujets particuliers. Les membres de FCI ont également la possibilité de s'inscrire au parcours de carrière exclusif de FCI, un programme de développement professionnel unique en 3 étapes de 18 mois, accrédité par le London Institute of Banking and Finance, visant à fournir aux participants les connaissances nécessaires pour devenir un professionnel hautement qualifié de l'industrie. FCI Academy a développé un ensemble de formations de bienvenue uniques pour les nouveaux membres de FCI, se concentrant sur les capacités les plus nécessaires pour le lancement et la croissance réussie de leurs opérations d'affacturage. Il comprend des programmes de formation sur mesure, offerts à la fois sur place et en ligne, et avec le soutien de membres expérimentés sous les auspices de notre programme de mentoring. Notre offre comprend également des webinaires, des programmes de masterclass en ligne et sur site, ainsi que des séminaires et ateliers couvrant tous les aspects de l'affacturage et du financement des créances. Les dirigeants de FCI et les professionnels expérimentés de l'industrie participent en tant que conférenciers et facilitateurs, partageant leurs connaissances et leur expertise dans leurs domaines respectifs. À FCI Academy, nous pensons qu'en transmettant des connaissances et une éducation de haute qualité à l'industrie du financement du poste client, nous contribuons à ouvrir la voie à des progrès continus et durables. Visitez notre site web et apprenez-en plus sur nos programmes et nos offres uniques, ou contactez-nous pour créer un programme d'apprentissage très efficace pour votre organisation. FCI Academy, le centre d'excellence pédagogique et de richesse intellectuelle de l'industrie du financement des postes clients.
Okay, so just to conclude my presentation, allow me just to highlight and mention a few more words about some of the items that you have already seen. About our digital learning program for 2023, you saw that FCI members, we have the career path for FCI Academy, which is an accredited learning program by the London Institute of Banking and Finance, but also we have very valuable programs also for non-FCI members. Whether you want to start from the entry level or on the foundation level, we have the Introduction to Factoring Receivables Finance course, and we also have the Fundamentals on Domestic and International Factoring course, which is a multilingual course offered also in French, not only in English. Along with that, we have recently introduced the Supply Chain Finance and Reverse Factoring course. It's again a foundation level course with modules on understanding the supply chain, global trade, reverse factoring, how we establish a reverse factoring program, and finally about FCI Reverse, FCI's a reverse factoring program. It has been launched in last January. It's available 6 times a year, but quite soon this is a program that will be available on demand, so you can take it whenever you want. We participate and we hold events globally. These are some on the left-hand side. You see some that already took place, and these are on the right-hand side. There are some of them that are coming. Of course, there are more in the list, but I didn't have so much place here to put, like the one we are having right now, and there are a few more coming for the second half of the year, and we are already start planning ahead for early next year. Something which is very valuable, especially for new members, are the tailor-made trainings. In FCI, we are building tailor-made training programs in all aspects of factoring, either separately or all together. And we design this program together with the organizations that we are delivering the program to. You see here a couple of examples. These both are members. We delivered them training on risk management, sales and business development, and legal and operational framework of FCI. Finally, allow me to conclude with 2 more aspects. With the participation and with the support of Afreximbank and the cooperation with the American University Cairo, we have launched many years ago, but this is the new version of the program, the Certificate of Trade Finance in Africa. It is a program that supports African professionals in building up a solid base and foundation skills on trade finance with special focus on the African region. There are a lot of practical cases, practical examples, and reference to the African and in supporting the inter-African trade. This program, the registrations for this program are open. You can visit our website. And those of you who would like to participate, you can read the terms and conditions of the program, and we will be happy to welcome as many from you as possible. And finally, there's something I think my colleague Nasuru mentioned. We are honored to be the main partner and the lead partner from African Development Bank group. Support for the emerging markets and having the FAPA grant, which is the Fund for African Private Sector Assistance, including 3 main areas: the consultancy project. We are offering consultancy services for African companies and banks to build capacities and skills. We have the Certificate of Trade Finance in Africa. It's a scholarship program, so part of the program is sponsored by this fund. And finally, we are offering e-learning courses from the FCI Academy learning courses that you previously watched on factoring and receivables finance under this grant. So take advantage of this. I'm sure my colleague Nasuru would be happy to contact you and get in touch with you in order to provide you more information. And having said that, I would like to thank you all, ladies and gentlemen, for your kind attention. And I invite you to visit our websites, and especially the website, the education part of our website. There is plenty of information there. And myself, Aishan, and all the FCI team will be more than happy to further contact you for more details and clarification. So thank you very much. This is the end of my presentation. Hugh, the floor is back to you. Thank you so much.
Yes, thank you, Spiros, for this very informative presentations. At least participants could really grab information on all the advantage of joining FCI, in addition to the key success factor in setting up a factoring business. The next presentation that it would be delivered by Afreximbank on factoring initiative in Africa actually complement very well what you have already presented, and particularly the advantage of joining FCI, because Afreximbank has also developed a strategy, and they have taken a multi-pronged approach to support the development of factoring in Africa, which really address different critical area like advocacy, the sometimes legal aspect, educations, and also financing, which I think is very critical here. But allow me, before we pass the floor to our colleague from Afreximbank, to take a few questions that are here. There are not many, but it's good that we address them, and before we move to the presentation of Afreximbank. And the presentation that we have here in the Q&A box, there's one that's really, it's on the digital financial service provider. What is the experience of digital service provider in the factoring industry? Ones that do not use their phone, but provide platform that connect the 3 parties, the buyer, the seller, and the financier. And then there was another questions on commercial dispute resolution. Could that be applied to or employed in factoring law? So probably the previous speakers, Spiros and Asian, can address these 2 questions. Spiros, Asian, Nasuru, I don't know whether you can answer the. Okay.
No, I'm here. So I checked the first question, but it is not easy for me to give a reply regarding the technology question indeed. I know how the IT works in factoring, but the question is not very clear to me. I don't know if Spiros or Nasuru can help in that.
Yeah, indeed. So yeah, any technology is good for the industry. So to know more buyer, to more clients. So, but at the end of the day, is help to support operation or factoring to have less risk. But you know, we are human. We can't replace human. So that means if you just want to control all the invoice, all the transaction made by human, by a machine, artificial intelligence, it could be you need to build something really really cover all the risk. But we hear a lot of platform on the market, like in India, in UK. So yeah, so it's depending also with your environment. If all the environment is real organized, so you have a credit bureau, you have payment repository, all the company register. We don't have informal companies. So everything is transparent. So we are able to have something can help a factory can help the development factory. But I'm not sure actually we can we can have a system or platform who can avoid the fraud or whatever. But we are talking about so many technology actually. But yeah, so if it's helpful, why not? This is thank you. This is what I want to say about this question.
Okay. What about the commercial dispute resolutions?
Yes, I
Very
can make
quickly.
some comments. Yeah, it is a very nice idea, but a little bit wishful thinking for the time being, I guess, because within FCI and also we are very much involved in the legal matters with the legal committee. We have a legal committee working on the dispute resolution or some disagreements if take place between the members of FCI as such. But commercial dispute is a very wide area. For each and every goods or subject for service, there are different standards, norms. So putting a one standard commercial dispute resolution rule or law, I don't know if it is possible. However, in the GRIF, I can say at least that. In the GRIF, GRIF is the general rules for international factoring. All members of FCI must obey and comply with these rules while they are doing business with each other, first of all. And these rules are very strict. And there we have the Article 27 regulating the disputes, commercial disputes between seller and the buyer. I can say this is something tangible which is employed in the laws of FCI. Of course, this is not the factoring law of a country, or this is not a jurisdiction in a country. However, this is a kind of law within the association which all members are committed and confirmed, so admitted they will act accordingly. And in that article, for example, it is very, very well clearly defined who is the party, who should notify the dispute to the other, what are the timelines for the notification, in case if it comes to the settlement of the dispute, what are the ways of the settlement, if it is an amicable settlement, which is a friendly way, negotiation, and etc. What is the timeline, and what are the role of export and import factors, if it will be a legal action, so who will start the legal action, there are different parties. So it really gives a very, very good framework how the commercial dispute should be resolved between the parties under FCI. Maybe this can be replicated in the factoring law, but as far as I know, the lawmakers don't want to touch that area, because commercial dispute is something which is not so it is very objective, so it is not something very subjective, not everyone can know about. So it can be just a few maybe indicators in the factoring law, because factoring law must be not very specific item by item, it should be also at a generic level. But in FCI rules can find something similar. Thank you.
Thank you, Ishan. Maybe on 30 seconds, not more. We are really lagging behind time. There is these questions on the real-time aggregate demand and transaction. You are seeing in the Q&A trail. I don't know where you want to answer it. I saw another questions in the chat box here, also on example of factoring in the agri-food sector. I think you really touch on that in the course of your presentation, but if you really want to address these two questions, maximum 30 seconds so that you can move to the
Okay,
next
so
one.
examples
Otherwise,
of
we move on.
agri-food, it can be again as said that fruits or vegetables, flowers, fresh fish, so agricultural food, so fresh food still being in use, but it has high risk. It's possible. There is also a lot of volume for factoring the dried material, like dried fruits, dried anything dried. This can be also counted to the agri-foods. This is my answer to that. The first question, real-time aggregate demand data. So I'm really too far to these concepts. I don't know what to say to this question. I'm not familiar with the subject and the concept. Sorry. Maybe some other speaker have an answer to that.
Thank you very much.
Thank you.
Nasur, you want to say something, or do we move to Frederick for the
Okay,
presentation of
that's good. I
Afreximbank?
think we already resolved the first question. So in terms of the experience digital service provider, so we've seen some in the market in the different countries, yeah, but sometimes the financier need to trust to the provider of the platform. So you have to have a trust before he accept any platform sharing with different banks. So that is the challenge people can face. Thank you.
Okay, thank you very much, Naso. Thank you, Asian Spiros, for this very enlightening presentation. We now move to the third phase of your program and the end, actually, coming very close to the end. We thank the participants that have stayed on board following the presentation. Please, we are moving fast and we are through to the end. Now, we'll invite Frederick to present Afreximbank Factory Initiative and Activity in Africa. You have the floor, Frederick. If you allow me, Frederick is a senior specialist in the Intra-African Trade Initiative at Afreximbank. That's for the purpose of introduction.
Okay, thank you, Hugh. I hope you can hear me. I hope you can see my screen.
Yes.
Okay, thank you. So really thanks to all the participants. I see you have stayed through very long presentations. Appreciate your time. I'll just take a few minutes to go through some of the factoring initiatives and activities that we at Afreximbank have been embarking on jointly with FCI and other strategic partners such as Making Finance Work for Africa. A lot of what I want to say has actually been covered by previous speakers, so I'll just skim through. But what I just want to do is, for the sake of those that are not here, just give an overview of who we are as a bank, Afreximbank that is. Also provide some context on why we're supporting factoring and why we think factoring is important to support in Africa, what our strategy is, and what the outlook and opportunities are, so we could invite other DFIs to partner and to work with us. As Madam Kana you said in her opening remarks, we are a DFI and an African multilateral international financial institution. We're 30 years old now, and we'll be celebrating that 30-year anniversary in Accra in June, as she said. We are primarily owned by 4 classes of shareholders, A, B, C, and D. I'll provide a bit more detail on that in the next slide. We are owned primarily by 52 African member states. Our structure is such that as the DFI, we're based out of Cairo, where our headquarters is. And then we have regional offices, 5 regional offices in Abuja that covers Anglophone West Africa. We also have Kampala that covers East Africa, Abidjan that covers Francophone West Africa, Harare that covers the Southern African market, and Yaoundé that covers the Central African market. As a DFI, we are investment grade rated by all three major rating agencies, by Moody's, by Fitch, and those ratings are as indicated: Baa1 stable for Moody's and BBB- stable for Fitch. We work on the basis of strategic plans as a bank, and for the current strategic plan period 2022 to 2026, we have our Impact 2026 strategy, where we intend to extend the frontiers of what we achieved under the plan 5. We're a purely African institution, DFI for that matter, and as I said previously, owned largely by African governments, and the structure of our setup is such that Afreximbank would always be owned and controlled by Africans and not anyone else, because our DNA is rooted in Africa, and we actually came out of a crisis in Africa, and so we needed to be responsive to those needs. So we have primarily governments, African governments and central banks, including, of course, the African Development Bank as our Class A shareholders, which control nearly 59.2%. Then, of course, we have the Class B shareholders, where other African financial institutions and private investors can take shares in, that represents about 25% of our shares. Then we have the non-foreign or non-African financial institutions and economic organizations, which also come up to about 10.3%. And then we have the depository receipts, which is the Class D, in which any of us on this call can also participate. It's a listing on the Mauritius Stock Exchange. So that is who we are as in terms of shareholding. Our strategic plan, as I initially indicated, 2022 to 2026, is largely hinged on 4 pillars. The primary pillar and the arrowhead of our strategy as a bank is to promote and implement intra-African trade and the AFCFTA. So that in essence is the full remit and focus of the bank for now. Then, of course, we recognize that in promoting intra-African trade and implementing the continental free trade area, you would need to industrialize and develop Africa. And so industrialization and export development is another area of our strategic pillar, where we need to promote export manufacturing through the promotion and creation of industrial parks, special economic zones, and things of the nature. Then, of course, our bread and butter as a bank has always been our leadership in global trade finance banking. Trade financing is the reason for which the bank was set up. And so we continue working to expand and deepen our trade offerings in Africa, improving the capacity of Africans in trade financing, and of course, improving access to trade finance for Africa and African banks. We currently have onboarded over 400 African banks as our clients, and we intermediating through these banks to improve the capacity of Africans in trade finance. Then, of course, we would need to operate sustainably in order to continue to be the bank that will capacitate trade, both intra and extra African trade. And so maintaining sound profitability, liquidity, and capital adequacy is one of the 4 pillars that we as a bank are very much monitoring and are implementing. This is to enable us continue to have relevance for Africa as our continent. Now I just go quickly, and Nasru has mentioned this, so I'll just draw out some of the few issues or highlights from this slide, talking of the volumes of factoring in Africa. Indeed, yes, we are happy to see there's a growing trend, which Peter also referred to in his remarks. There's a growing trend in Africa, currently at 32.3 billion euros, sorry. And so we continue to see a growth. However, as we all know, it's just under 1% of the total global factoring volumes. It means there are opportunities for Africa to grow. There are opportunities for Africa to leverage more of factoring to support this SME base, which we all know is the engine of growth most of our economies. Now, if we go beyond or try to get into the detail of this $32.3 billion that Africa did as factoring, we realize there are certain intriguing statistics. Of course, the first being that we recognize that these volumes are highly concentrated. You can see that mostly it's in South Africa that leads in when it comes to volumes of factoring in Africa, about 85%. Then, of course, Morocco and Egypt, then Mauritius in that order. But again, these are, as some of the previous speakers have also said, these are FCI reported figures. There are lots of companies probably that are doing factoring in one way or the other that are not reporting these figures. And so the clarion call is that indeed we need to expand the scope of countries that do factoring and who do reporting on factoring volumes. That is through the FCI. So again, this is the challenge that we would want to throw out there to the various financial institutions, commercial banks, and DFIs in Africa. We really need to continue to work to improve the environment, to have more factors join FCI and more factors to report and to provide data on factoring on the continent. I'll just quickly then move on quickly, and this dovetails into some of the challenges that we have seen on the continent when it comes to factoring. And these same challenges are what have informed some of the activities and some of the strategies that as a bank we are implementing. And this has also been variously alluded to by some of the speakers. Recognize knowledge is a big issue. And therefore, part of this process and part of this training that we are holding today is because we recognize the need to capacitate and to bring a lot of African financial institutions and factoring companies together to improve the awareness, to improve the skills, to improve the capacity building of the industry. Then, of course, we again recognize that there's a need to build our regulatory environment, which we have also variously discussed on this platform. A codified system of centralized codified system of factoring regulations would create for easier implementation, would create for certainty in implementing factoring, the factoring product. And of course, we also recognize that there's a lot of payment information on the continent, which in itself also then affects the ability to get trade credit insurance. So again, a major challenge, both on the leg of having information on the various parties, which one of the participants alluded to, but also information or lack of trade credit insurance on the continent. Then, of course, as we all previously heard, the major products under factoring of the four types that Aysen mentioned is financing, and not just financing, but it has to also be competitively priced. So again, the lack of competitive pricing being a major inhibitor to factoring on our continent. What we have then done as a bank, and this goes to the activities and the initiatives that we've put in place, is to come up with a strategy, which we called FLAX, where the primary intervention for the bank is what we call financial intervention. So under the financial intervention pillar as a bank, we're working with factoring companies, with banks to provide lines of credit and guarantees to support factoring activities. Essentially, under this pillar, we have in the past few years, 3 years on the average, extended over $100 million to various factoring companies, which they can then leverage and turn over multiple times to support factoring. As Madam Kanaye said this morning, there was a facility signing ceremony here at the Afreximbank head office in Cairo with the BPC, Banque Postale du Congo, to give them a facility, a line of credit to support factoring. And again, these are opportunities and areas of collaboration that we can have with other sister DFIs in supporting various factoring companies and supporting various commercial banks in their factoring activities. The cost of financing, as we indicated, is a key and major issue. And so if there were any opportunities to have some forms of blended financing, for factoring companies that we can then on-lend to some of these factoring firms and banks. That will be a major step forward and a major relief to the industry. So an opportunity or opportunities are open in this space for collaboration with Afreximbank to provide a blended financing, both commercial and then the commercial or concessional financing that we can use to on-lend to our factoring companies. And of course, to factoring companies that are on the platform, Afrexim is open for business in providing for your financial needs. We are happy to engage with you to provide lines of credit or guarantees if this is what your market requires, to enable you on lend and to enable you underwrite the various factoring transactions that you have in your markets. Very important pillar. Then the next pillar we have in the strategy that we have been implementing is what we call the legal and regulatory framework. As we said, in 2016, the bank developed a model law, which is a codified, centralized model law that puts together all the various requirements, that puts together all the various steps that we would want to see in a law that has certainty, that is transparent, that is in one central location, that can be leveraged by all parties involved in factoring. So again, the clarion call, as Madam Kana you earlier mentioned, is that we have seen some uptick in the adoption of the model law. In Cairo, for example, or in Egypt, we in 2018, the factoring model law was used, or the Afrexim factoring model law was used to as a guide to then pass a law on factoring in Egypt. And we have seen since then a growth in factoring from just about 5 companies that used to do factoring. Today, there are about 32 companies when I last checked. So again, a very important tool that we have in our toolbox that we can deploy to our various partners in your engagements with your various governments, in your engagement with your various parties. I think it's important to recognize that a stable, clear legal regulatory framework on factoring is important. That model law is not something that is prescriptive, but it's a guide. You can review it. We're also available to provide various technical supports. And we have done that in the case of Congo, working with BPC and through the World Bank to adopt and let the law reflect some of the nuances in the country, for which in 2022 they passed in 2021 they passed the model law. BCAO, as we said, we have had a lot of engagement with the BCAO, the Central Bank for West African States, and again, thankfully, that law has also been passed and now being domesticated in the various markets. So again, very good opportunity for our various partners, working with Nexim in Nigeria as well to ensure that the factoring model law is passed. But again, happy and available to work with any other partners, DFIs and commercial banks that may have direct government access, that may have direct counterparty access in facilitating the adoption of a factoring law or the development of factoring law for our various countries in Africa. Then the third pillar that we very much have been blazing on all this while, and which is part of today's event, is the awareness and capacity building. Indeed, every year we host about 3 events just to try to continue to build capacity and train and provide skills for our continent. Spiros mentioned some of the various training programs that we also have, such as the COTFIA, which is Certificate of Trade Finance in Africa program that we are leveraging and which is currently open for participants to go through a rigorous process of training to understand trade finance and build staff capacity, which is very key if you are to succeed in the factoring world. Of course, working with FCI, we have also deployed the FAPA grant, as Nasru mentioned, and of course Spiros as well. We have used that to build a capacity training workshop I think that was in November, December in Senegal, where some factors were trained in how to set up factoring operations and how to operate sustainably as a factor. I think later in June this year, there will be a second leg for some of the countries and some of the factors in Nigeria, which we're also working on as part of this continuous effort to provide technical training to factors. We will, of course, as well, continually invite you to some of our various programs, capacity building and awareness programs that we do host in Afreximbank. The next one coming up would, of course, involve the annual general meetings in Accra. We usually have a side event on factoring and a workshop or training event on factoring. Again, we'll be happy to see you there and continue this continuous learning process of improving our knowledge, but also advocating for the creation of the right legal environments, for the creation of the right regulatory environment for factoring to thrive on the continent. Then, of course, strategic partnerships and services, again, very important part of our strategy. This collaboration is one of those that we have with Making Finance Work for Africa. And to bring this to, at one count, I saw almost 170 participants. This is one of the strategic partnerships that we are very proud of. And we're happy to extend this same strategic partnership to the various DFIs that are on this call, or commercial banks that see mutual benefit and mutual partnership with Afreximbank in growing factoring on the continent. We are happy to work with you in various ways, depending on your strategic objectives and what you want to achieve in factoring. We can discuss and see how best we can collaborate with you in developing factoring on the continent. As a bank, we also recognize that we need to do some heavy lifting so factoring can thrive. And one of those heavy liftings that we're doing has been to engage a consultant to do a feasibility study for a payment repository. And again, this just goes to trying to solve for the issue of lack of credit insurance on the continent. One of the activities that we're doing, or we feel may have an impact, is through the use of a payment repository, where various factoring companies can then contribute data, can contribute information that becomes a basis for credit insurance or credit underwriting, either on the factors or directly on buyers, as the case may be. So again, in a nutshell, that's the core of what we do. We're more than happy to work with various DFIs that may want to also develop a factoring strategy, that may want to have our advisory services for developing a factoring intervention in their various institutions, either directly or indirectly. We do the indirect method, where we support factoring companies. We provide on lending to banks to support the final users. But of course, you may also want to set up a direct factoring subsidiary. And as we have seen previously, 50%, over 50% of all factoring companies are actually banks or subsidiaries of banks. So indeed, an opportunity in that space for our participants on the call. In terms of outlook, we're very optimistic, seeing what the trend has been, as Peter said, a positive and growing trend for Africa, still lots of opportunities. But we're even more thrilled when we look at the fact that there's an increased adoption of the model law in Africa that gives investor confidence, that gives investor certainty, into the sector. And so we're seeing lots more companies that are getting into factoring, lots more banks that are setting up factoring subsidiaries or directly getting involved in factoring. And of course, we would continue to work with our various strategic partners to provide the capacity building and technical assistance that these companies would need to grow and to project factoring to the levels that we all believe. I know FCI has made some projections that from the current $32 billion level, this should go up to about 50 in the next 2 years by 2025. And we think there's opportunity to hit that level, given the growing intra-African trade volumes that we're seeing on the continent, and of course, with the implementation of the AFCFTA, lots of opportunities for banks to intermediate in this space and to support the SME sector in Africa. So I think this is the end of my presentation. I just wanted to quickly just also put out there and to extend invitations to all members to our annual general meeting and the trade fair, which would hold shortly in November. I thank you for your time and attention. Thank you.
Thank you very much, Frederick, for this very this informative presentation. I think with this presentation, we have, I mean, the full pictures of all options that are available on the continent for institutions and policymakers. I mean, the option to establish or grow a factoring business, or to create or adopt regulations that can really support the factoring business. There are a few questions that are here in the Q&A box. We will keep them and allow Marina to come and make also her own presentation on making finance work for Africa, and then we'll come back and address the two questions before the winding of the meeting. So Marina, you have the floor.
Thank you, Eric. Let me please share my screen. Okay, so I will make a very quick presentation of making finance work for Africa as promised at the beginning of the session. So making finance work for Africa, it's a partnership which was launched more than 10 years ago. We are hosted by the African Development Bank, and the partnership was created in recognition that the African financial sector is key if you want to effectively develop Africa and address its different challenges. And in order to advance the African financial sector, collaboration between various stakeholders is needed, is important. These stakeholders include government, development partners, the financial sector, private sector, etc. So our mission is really to make the African financial sector work in response to the Africa's most pressing challenges. These challenges will include poverty, gender inequality, climate change, and unemployment. So what are we doing to achieve this mission? We have two kinds of activities. The first one is our historical activity, if I can say that. It's everything related to knowledge repository, knowledge sharing, knowledge dissemination. So we have a very important action-oriented researches. This research will be made to analyze the trends and the challenges in the African financial sectors. And the purpose is to share the insights gathered with the relevant stakeholders to make the action more efficient. It will include also country diagnosis and profiles on the African financial sector, or for example, the state of the long-term finance. All of these resources are available on our website. More than a website, is really a knowledge hub that we put at the disposal of our followers and our members. Besides these knowledge repository activities, we also have what we can call market facilitator. So here we will find activities such as policy dialogue, capacity building, for example, the webinar we are attending now, advocacy, networks, and communication of practice. So here we will perform different kinds of activities to facilitate the work of our different members, whether DFIs or commercial banks, basically any stakeholders interested and involved in developing the African financial sector. So currently we are focusing on 4 areas. And trade finance, I will state with this one because it's really related to the webinar we are attending now. Trade finance, here our objective is really to to reduce and eliminate systematic barriers to expand the trade finance in Africa. So under this activity, we will have the promotion of alternative financing instruments such as factoring. We will also work on compliance issue because it's key to trade finance. And this is just one part of our our strategic focus of area of focus. There are 3 others, one that you can see on the slide, and all of them are very related to UN Sustainable Development Goals. The first one is inclusive and alternative finance. Here we want to make finance accessible and affordable to the needs, to meet the needs of the underserved and the non-served. That's what I was saying at the beginning of the session. That will include SMEs, women, youth, etc. We also have a pillar under the long-term finance where we want to contribute to reduce the financing gap that we can observe on long-term finance. So here, the objective is to develop a financial market that will contribute to finance the real economy. That will include infrastructure, energy, housing, etc. And the last one is related to banking system, because you know that in Africa, banks are the most important part of the African financial sector. So it's really key to support this industry, which is quite particular, very hard regulated. And our objective here is to make sure that we will have in Africa vibrant and stable banking system here again, which will be able to support the needs of the real economy. Under these 4 pillars, we put a high emphasis on everything related to gender, climate change, and technology disruption. So we, as I said, we were launched more than 10 years ago. And if I have to put in one sentence, our competitive advantage is we are uniquely able to connect the various parts and actors of the African financial sector, because this was the very basis on what we were created, is to make the various stakeholders collaborating. So over the year, we managed to create this important network and to facilitate the action of the stakeholders and also between the stakeholders each other. Partnership is one important value from us. Again, this is related to our belief in collaboration that I mentioned earlier. So as I said, we are hosted by the African Development Bank. So we are a membership partner, we are a member-based organization. So that means that we are supported by different members. So on this slide, you can see our current members. The African Development Bank is one important because we are hosted by them actually, but we are also supported by AFG, Afreximbank, TCX, and the European Investment Bank. And besides these funding partners, we work with many other organizations under the form of strategic partnership or collaboration of specific initiative or work program. You can see a sample of these partners and collaborators on this slide. Here on this slide, I won't spend too much time on this, but you have some example of our achievements over the years. We can have them in 3 categories. Working group and network, for example, we work closely and support the community of African banking supervisors and other network that we manage to launch to promote. We also have strong and relevant initiatives. For example, currently we are working on the Africa Long-Term Finance Initiative to support the deepening of long-term finance market to Africa. And we are working on this initiative. For each of our initiatives, we will involve many stakeholders, partners. So for this one, we are working with IFTB, FSG Africa, for example. And of course, everything related to knowledge repository. So all our activities related to knowledge gathering and then knowledge dissemination. That will include some flagship publication, series of webinars, and of course our website. I mentioned it is a hub, a library of more than 2,000 publication reports, policy papers, and research studies. So the partnership is at very exciting time. So we are working on our current strategy. And what we want to do is to scale up our resources, to scale up our impact not only on the African financial sector, but on the real sector as well, because we believe that advancing the financial sector will have a clear impact on Africa, on its economy, and also to the livelihoods of its population. So this is something that where we want to extend our outreach, our membership, and also try to make our activities more relevant and more impactful. We have very large ambitions to bring systematic change in the African financial sectors. So please, we welcome any stakeholders in our membership, any stakeholder interested in developing the African financial sectors. It will be DFIs as our current members, but also philanthropic, foundation, commercial banks, and any other actor from the African private sectors. So you will have this presentation as promised by the end of the week with all the presentation displayed today. And you have our contacts if you want to know more about our partnership, or if you're interested in engage with some of the initiatives we are working on. Thank you.
Yes, Marina, thank you very much for this quick overview of making finance work for Africa. I think it's very great opportunity people to know more about the partnership. The contacts are there. If you want to ask more questions as for the presentation, please do not hesitate. I was told that at the end of this presentation, we have a slide with a Q&A code for the satisfaction survey, and we really invite you to well, fill up or really to I didn't say it's a tag, but how you do, but really to address this survey. We really value your feedback. It really improves the quality of future women, and also to tailor some of these programs in such a way that it addresses more your needs, and also to know exactly what's our expectations going forward. I'll now come back to the two questions that were in the Q&A box, with the all directed to Frederick, I understand. I will invite him to pick the two questions, and maybe if any questions come from Marina, she will also answer. I think the first one was on, actually it's just a small comment, but it's a GIZ saying that they want to be a strategic partner of Afreximbank in Nigeria. How can they formalize this relationship? And the second one was, does Afreximbank offer factoring line of credit in local currencies such as Naira? So Frederick, I don't know whether you can answer the two questions.
Okay, thank you, Hugh. So yes, to the first question, in terms of being opportunities for strategic partnerships in Nigeria with GIZ. So what we will do is, Akinwade, if you can get in touch or send us your email in the chat, we would get in touch with you. Then we could discuss and explore how we can formalize it, and which areas of cooperation and collaboration you think we can engage. So please just drop your email in the Q&A. I'll take it up, and then we'll be in touch with you to discuss opportunities and areas of collaboration. Now, on the second question, whether we offer lines of credit in local currencies, this is a possibility. Of course, we would need to look at the specifics of the transaction and discuss that. So we can engage. Of course, David, you can also drop your details in the chat. We would be in touch to explore it. The other option that I think we can also look at, David, is where we would provide a facility or a line of guarantee, a guarantee to your local bank, where your local bank then gives you the Naira. But of course, we are still taking your risk. But yes, we can look at various ways of making this work together with your local banks. But of course, we would discuss, we can discuss and explore these options. Thank you, Hugh.
Okay, thank you very much, Frederick. On the previous question related to the local currency financing, maybe let me make a link with the presentation Marina made and the partner that she mentioned or displayed on the slide, on one of the slides. We have a collaboration with a partner called TCX, which is actually specialized in the Forex aging, and they might be invited to be part of this. I mean, I don't know, it's a transaction, but all the thought process on how they can help to maybe mitigate any risk that is associated with issuing a local currency financing. So do not hesitate also to bring this to attention, and Making Finance, we can route that request to them, and they will see how they can really support and maybe to de-risk the transaction and unlock the finance. I see also one patient here that is on how can the company join the network of SME support program. It's actually a network of SME support agency, which are there to provide business development services to SME. The membership is more in West Africa, Francophone West Africa, the WAMU region. But if that is of interest, please let us know. We were also very open to have similar network maybe in other part of Africa. It takes a bit of time to build that up, but it's always interesting to hear what are the expectations of stakeholder on the continent. On that, I think we have covered most of the point. There's no questions left. I think we can be comfortably invite Marina to deliver the closing remark. Again, invite you really to address our survey before you leave the platform. Thank you very much. Marina, you have the floor.
Yes, thank you, Hugues, and thank you to all our participants for the patience as we are running a bit out of time. So first of all, I just want to quickly remind and emphasize some of the key messages we received today during the opening remarks. And thanks again to Mr. Malvo, Madame Kanouye, and Mr. Okoye for sharing these valuable insights. So first, it's necessary to support the African SMEs because they are the backbone of our economies. These African SMEs are suffering, as we all know, of an important financing gap, and factoring can efficiently address this financing gap. And factoring is also a profitable business if it is well managed. And we are observing growing trends in Africa. It is very encouraging, but there is so much to be done. The objective of factoring volumes in Africa are quite high. And in order to achieve this objective, here again, collaboration is needed, is required to effectively take down all the different barriers from developing effective factoring activities in Africa, whether there's a lack of knowledge, lack of awareness, unfriendly regulatory environment, and so on. Everyone, from policymakers to commercial banks, has a role to play in this. Today, the webinar we just attended all the afternoon or morning or evening, depending on where you are, gathered DFIs, commercial banks, organizations such as FCI, Making Finance Work for Africa, and others institutions. And this is a very good example of the collaboration which is needed to effectively advance the development of the factoring activities in Africa. I want to thank again Mr. Okoye and the Association of African Development Financial Institutions for giving us the opportunity to hold this virtual session. I am confident that this webinar helped the participants to better understand the factoring survey mechanics, techniques, risks, and the key factors of success. And for that, I want to comment and thank the FCI speakers, Mr. Aminou, Mrs. Sidentas, and Mr. Solis for the expertise and the elaborate presentation. And please keep in mind that if you want to develop this activity, you are not alone on this. You can have support, whether it's financial or non-financial support from organizations such as FCI here and the Afreximbank to help you put in place successful factoring activities within your organization. Last but not least, I want to thank you all the participants for their attendance today. I really hope that you enjoyed this session and you will join us, the institution organizing and hosting this webinar today, Making Finance Work for Africa, Afrexim, FCI, and so many others on this important journey to develop the factoring activities in Africa, and doing so, ensure the growth and sustainability of our SMEs. Thank you again for your attendance.
Thank you very much, Marina. My role also ends here as a moderator of this webinar. I would like to commend all the participants for staying connected for so long. We had more than 160, even 70 participants at the time. The peak time has dropped a little bit, but we are more or less stay above 100 participants. Maybe just as a last word as well on my side to thank all the interpreters. They're always behind the scene, not seen, but they are doing a tremendous work. And also Gwendolyn from FCI that has been managing the logistics on the other side. I think on that I don't know if say apology, but we have done our best to manage the time, keep it the event within the time, but I think we have not gone very far. Thank you so much for staying with us, and I think we can now wind up the meeting, and have a good day. Bye-bye.